Long before modern banks occupied marble buildings in financial districts, systems of lending and safekeeping emerged in agrarian societies shaped by seasonal uncertainty. In river valleys where harvests determined survival, surplus grain became both wealth and risk. Communities required trusted places to store that surplus against famine, flood, or conflict. Temples and palaces gradually assumed this responsibility, not merely as religious or political centers, but as economic anchors. Priests and administrators recorded deposits on clay tablets, tracking obligations with careful notation. These records represented early attempts to formalize trust through documentation rather than memory alone. Over time, the act of storage evolved into the act of lending, as idle reserves were redistributed to farmers and traders. The institutionalization of this process marked one of the earliest foundations of organized banking systems. By 3000 BCE, in the cities of Mesopotamia such as Uruk and Uar, temple complexes operated as central repositories of grain and silver. At the time, silver functioned primarily as a unit of account rather than as coinage. Debts were denominated in standardized weights, and repayment terms were often linked to agricultural cycles. According to surviving cuneiform tablets, interest rates on barley loans could reach 20% annually. By 2000 BC, legal codes such as the Code of Hammurabi formalized lending practices and specified penalties for default. These laws reveal a society already concerned with risk, collateral, and contractual enforcement. The temple's dual role as sacred institution and economic intermediary strengthened public confidence. Financial obligations were framed not only as legal duties but as moral commitments. The mechanism that sustained these early banking activities relied on centralized record-keeping and predictable agricultural output. Depositors entrusted grain or precious metals to temple authorities because storage facilities were secure and professionally managed. The reason this arrangement worked was rooted in scale and specialization. Individual households lacked the infrastructure to protect large reserves from spoilage or theft. Temples possessed granaries, guards, and scribes trained in accounting techniques. This works because the concentration of resources reduced overall risk for the community. Loans issued from these reserves financed planting, trade expeditions, and craft production. Repayment with interest replenished and expanded the communal surplus. Over time, this cycle generated an early form of capital accumulation within institutional walls. In ancient Egypt, a similar integration of religion and finance developed along the Nile. By 1500 BC, temple estates controlled vast tracts of agricultural land and coordinated labor across regions. At the time, grain receipts functioned as transferable claims, allowing merchants to settle obligations without physically moving crops. Studies of papyrus records show structured lending agreements with specified maturities and penalties. The centralized authority of the pharaoh reinforced contractual compliance. Administrative offices attached to temples managed inventories with bureaucratic precision. This historical continuity demonstrates that financial intermediation did not arise in isolation. It was embedded within political hierarchies and cosmological belief systems. Economic trust was inseparable from spiritual legitimacy. As trade routes expanded across the Eastern Mediterranean, private moneylenders began operating alongside temple institutions. Merchants required flexible financing for voyages that extended beyond local harvest cycles. Independent lenders offered silver advances for caravan trade and maritime expeditions. These arrangements carried higher risk and therefore commanded higher interest rates. The emergence of private credit introduced competition into financial intermediation. Contracts became more detailed, specifying collateral in land, livestock, or future cargo. Written agreements reduced ambiguity and provided recourse in disputes. Over time, a layered system formed in which temples, palaces, and private lenders each served distinct economic niches. The diversification of lending sources marked an early step toward complex banking ecosystems. The reason international banking would eventually emerge from these foundations lies in the portability of credit. Grain stored in a temple could not easily travel across deserts or seas. Silver measured by weight offered greater mobility, but still required physical transfer. The mechanism of written obligation transformed value into something transferable without immediate movement of goods. This works because a documented promise could circulate as a claim on stored wealth. Merchants learned to exchange tablets and sealed contracts as proxies for payment. Trust shifted gradually from physical commodities to enforceable records. This conceptual leap allowed economic relationships to extend across distance. Administrative literacy became as important as material reserves. By the first millennium BC, networks of trade connected Mesopotamia, Egypt, Anatolia, and the Levant. At the time, financial practices traveled alongside merchants and diplomats. According to economic historians, standardized interest conventions began appearing across regions with shared commercial exposure. Silver hoards discovered in archaeological sites indicate accumulation beyond subsistence needs. Lending was no longer confined to survival agriculture but supported long-distance commerce. Temples still operated as custodians of wealth, yet private financiers increasingly mediated cross-border exchange. These developments laid groundwork for more sophisticated institutions in classical antiquity. The architecture of early banking had been assembled gradually through experimentation and adaptation. Within these early systems, the central challenge remained the management of trust across uncertainty. Harvest failures, political upheaval, and warfare threatened repayment cycles. Institutions responded by codifying rules and diversifying borrowers. Interest compensated lenders for temporal delay and potential loss. Record-keeping evolved into a professional discipline, with scribes occupying respected positions in urban society. Financial authority rested not only on wealth but on administrative competence. As surplus production intensified and trade corridors widened, the demand for reliable intermediaries continued to grow. What began as temple storage gradually assumed the characteristics of organized credit networks, setting in motion structural patterns that would expand across continents and centuries. As temple-based finance matured, its administrative practices became increasingly standardized across regions. Scribes developed consistent methods for measuring silver, recording obligations, and calculating interest over fixed periods. Clay tablets were impressed with seals that authenticated transactions and identified responsible parties. These seals functioned as early signatures, linking identity to obligation in a durable form. The reliability of written contracts allowed lending activity to expand beyond immediate kinship networks. Credit relationships no longer depended solely on personal familiarity. Instead, institutional reputation provided assurance that agreements would be honored. Over time, the authority of temples rested as much on procedural consistency as on religious reverence. This administrative stability enabled economic exchange to scale beyond village boundaries. The mechanism underlying this expansion was the abstraction of value into units of account. Silver weights, grain measures, and standardized ratios allowed diverse goods to be compared and exchanged. The reason abstraction mattered was that it reduced negotiation friction in every transaction. When value could be expressed numerically, obligations became calculable rather than arbitrary. This works because quantification limits ambiguity and constrains disputes. Interest rates, repayment schedules, and penalties could be expressed with precision. Borrowers understood the cost of delay, and lenders understood expected returns. Such clarity reduced conflict and encouraged repeated interaction. Over decades, these practices embedded mathematical reasoning into commercial life. By 700 BCE, coinage began circulating in parts of Anatolia and the Aegean world. At the time, stamped metal pieces represented a further refinement of monetary trust. Coins guaranteed weight and purity through state authority rather than private verification. According to numismatic studies, early coins facilitated trade in marketplaces where parties lacked established relationships. Standardized currency reduced the need for weighing metal during each exchange. Temples and money changers adapted quickly, integrating coin deposits into existing accounting systems. The coexistence of commodity money and coined currency diversified financial tools. Lending could now be denominated in more portable and divisible forms. This historical shift accelerated commercial interaction across coastal regions. Private moneylenders increasingly specialized in currency exchange as trade routes multiplied. Merchants traveling between regions confronted differing weight standards and metallic compositions. Money changers profited by converting one form of currency into another at negotiated rates. These exchanges required knowledge of regional conventions and political conditions. Financial expertise became a marketable skill distinct from religious authority. Contracts expanded to include clauses covering foreign trade risks and maritime hazards. Insurance-like arrangements emerged informally through risk-sharing partnerships. Over time, economic actors relied on professional intermediaries who operated beyond temple hierarchies. The separation between sacred and commercial finance gradually widened. The reason this specialization mattered lies in risk distribution. Long-distance trade exposed capital to theft, shipwreck, and political instability. The mechanism of shared investment reduced the burden on any single merchant. This works because losses could be absorbed collectively while gains were distributed proportionally. Written agreements specified each partner's contribution and entitlement. Interest rates reflected not only time but also uncertainty. Lenders evaluated routes, seasons, and reputations before committing funds. Financial decision-making became increasingly analytical. Calculated risk replaced purely customary obligation. These evolving techniques foreshadowed later banking innovations centered on portfolio management and diversification. By 500 BCE, urban centers around the Mediterranean exhibited recognizable financial districts. In cities such as Athens, trepidati operated tables where deposits, exchanges, and loans were negotiated. At the time, these private bankers accepted coin for safekeeping and transferred balances between clients through written instructions. According to surviving speeches from Athenian courts, disputes over loans and maritime contracts were litigated with detailed evidence. Legal frameworks adapted to protect depositors and enforce repayment. Financial services expanded beyond trade into personal lending and estate management. Coin circulation stimulated broader participation in credit markets. Economic life became intertwined with professional banking activity. Parallel developments occurred within the expanding influence of Rome. By the 3rd century BCE, argentarii facilitated payments at auctions and public markets. At the time, ledger entries enabled clients to settle debts without transferring physical coin. According to Roman legal texts, bankers could act as guarantors and intermediaries in complex transactions. State expansion created demand for tax collection and military provisioning across territories. Financial agents bridged distances within a growing political framework. Administrative uniformity supported predictable contractual enforcement. Banking practices thus integrated with imperial governance structures. Economic coordination extended across provinces through institutional mediation. These classical systems retained foundational elements first developed in temple economies. Record-keeping, standardized value, interest calculation, and institutional trust remained central pillars. Yet the scale and geographic reach of financial activity expanded dramatically. Cross-regional commerce required mechanisms capable of operating beyond local oversight. Professional bankers filled this role by combining accounting skill with reputational capital. As trade intensified and political entities consolidated power, the need for reliable financial intermediaries deepened. The structural patterns established in antiquity would persist through subsequent transformations. Emerging networks of credit and exchange prepared the ground for more complex international banking systems that would evolve in later centuries. As classical civilizations expanded, financial systems became more deeply embedded within state administration and long-distance commerce. Banking was no longer confined to temple courtyards or market tables. It intersected with taxation, military logistics, and imperial infrastructure. Public revenues flowed through organized channels that required accounting discipline and predictable transfer mechanisms. Deposits funded not only private ventures but also state expenditures. This integration altered the scale of financial responsibility. Institutional credibility depended on maintaining solvency across vast territories. The complexity of these obligations demanded increasingly sophisticated oversight and coordination. In the Hellenistic world following the campaigns of Alexander the Great, commercial networks stretched from the eastern Mediterranean into Central Asia. At the time, newly founded cities functioned as nodes of exchange linking diverse regions. Coinage systems were harmonized across territories to facilitate trade and tax collection. According to surviving inscriptions, royal treasuries accepted deposits and issued payments to military officials stationed abroad. Financial administration supported the movement of goods such as grain, metals, and textiles across long corridors. Bureaucrats maintained ledgers tracking inflows and outflows with methodical precision. Political expansion reinforced monetary standardization. Economic coordination increasingly relied on institutionalized record-keeping rather than personal negotiation. The mechanism that allowed such coordination was transferable credit. Instead of transporting large quantities of coin over dangerous routes, merchants could rely on written payment instructions. The reason this innovation mattered was the reduction of physical risk and transport cost. This works because value could be reassigned through documentation without immediate movement of metal. Trusted intermediaries guaranteed that distant counterparts would honor claims. Reputation functioned as collateral in many cases. These arrangements resembled early bills of exchange, though terminology differed. Financial trust extended along commercial corridors supported by legal enforcement. Administrative literacy thus underpinned economic integration across regions. Within the Roman sphere, the consolidation of provincial governance intensified these practices. By the 1st century CE, the Roman Empire maintained tax systems spanning Europe, North Africa, and parts of the Near East. At the time, publicani and banking houses collaborated in revenue collection and fund transfers. According to Roman jurists, bankers recorded deposits in codices that could be referenced in legal disputes. Settlement of accounts sometimes occurred through book entries rather than coin exchange. This method reduced transaction friction in large commercial centers. State stability encouraged depositors to entrust savings to established firms. Financial networks paralleled imperial roads and shipping lanes. Administrative uniformity reinforced economic predictability. Yet these systems remained vulnerable to political disruption. The mechanism of banking depended on confidence in enforcement and continuity. When warfare or succession crises undermined state authority, deposit withdrawals accelerated. The reason instability threatened solvency was that reserves were often lent out rather than held idle. This works because banking transforms short-term deposits into longer-term obligations. Sudden demand for liquidity exposed structural fragility. Historical accounts describe episodes of credit contraction during periods of unrest. Interest rates fluctuated in response to perceived risk. Financial institutions learned to manage reserves cautiously during uncertain times. These cyclical pressures shaped early understandings of systemic vulnerability. By late antiquity, as imperial cohesion weakened in parts of the Mediterranean, localized financial practices reasserted prominence. Urban contraction reduced the scale of commercial exchange in some regions. At the time, temples and local elites once again assumed custodial roles within smaller economies. According to archaeological findings, coin circulation diminished in certain areas while barter regained importance. Nevertheless, techniques of record-keeping and interest calculation did not disappear. Knowledge persisted within administrative traditions and legal codes. Regional trade continued along surviving routes, though at reduced intensity. Financial memory endured despite political fragmentation. Institutional habits proved resilient even amid structural decline. Across these centuries, the concept of credit matured into a transferable and negotiable instrument. Merchants learned to rely on documents that represented stored value elsewhere. The mechanism of deferred payment supported expanding trade networks without proportional increases in metal supply. The reason such systems endured was their efficiency in allocating capital across distance and time. This works because surplus in one region could finance opportunity in another. Financial intermediation thus became a connective tissue binding disparate markets. Trust shifted gradually from sacred spaces toward professional expertise and legal frameworks. Institutional continuity provided stability during transitional eras. Economic coordination extended beyond the lifespan of individual rulers. By the close of antiquity, foundational elements of international banking had taken recognizable form. Deposits, loans, currency exchange, and transferable credit were embedded within commercial life. Administrative literacy supported contractual enforcement across borders. Financial actors operated within layered systems shaped by law, custom, and political authority. Though fragmented by shifting empires, these structures transmitted knowledge forward into medieval societies. The gradual refinement of accounting and risk assessment would enable later innovations in merchant banking. What began with grain storage in temple granaries had evolved into interregional networks of credit and obligation, setting the stage for the transformation of banking in the centuries that followed. Trade networks expanded steadily across the Mediterranean and Northern Europe, linking ports, markets, and financial houses into increasingly complex systems of exchange. The temples and early moneylenders of earlier eras had established principles of trust, record-keeping, and credit, but commerce in the late medieval period demanded new institutional forms. Merchant banks emerged within this environment as specialized intermediaries between traders operating across long distances. Their role was not limited to storing deposits or exchanging coins. They structured transactions, absorbed risks, and advanced funds against future deliveries of goods. In cities such as Florence, Venice, and Genoa, commercial families developed financial houses that combined trade and banking under one roof. These institutions were embedded in networks of correspondence that stretched from Iberia to the Levant. Their letters carried instructions, price data, and settlement orders across weeks of travel. Commerce was becoming abstract, and money increasingly moved through ink and reputation rather than metal alone. By the 13th century, The growth of fairs in regions such as Champagne had created periodic gatherings where merchants from multiple kingdoms met to settle accounts. At the time, transportation was slow and dangerous, and carrying large quantities of coin exposed traders to theft and loss. The bill of exchange developed as a practical solution to this constraint. A merchant in one city could deposit funds with a banker and receive a written order instructing a partner in another city to pay a specified sum to a named recipient. By 1300, this instrument was widely used across Western Europe. It allowed settlement without the physical movement of specie. According to commercial records preserved in Florentine archives, entire cargoes of wool and spices were financed through chains of such documents. The practice created a layer of credit that rested on trust between banking houses. The system depended on reputation and the expectation of repayment at maturity. The mechanism of the bill of exchange relied on time, distance, and currency differentials. The reason it functioned effectively was that it combined payment and foreign exchange into a single instrument. A banker could issue a bill payable in another currency at a future date, embedding a margin that reflected exchange rates and interest. This works because the delay between issuance and settlement allowed compensation for the opportunity cost of funds. It also complied with religious restrictions on usury that limited explicit interest charges in certain jurisdictions. The mechanism converted what might have been labeled interest into a fee expressed through exchange differences. Merchant banks therefore operated within both economic and moral frameworks. They calculated risk based on the solvency of counterparties and the political stability of routes. Failures did occur, but diversified networks reduced the impact of localized shocks. In Florence, powerful banking families such as the Medici and the Bardi built branches in multiple European cities. By 1400, Florentine banks maintained representatives in London, Bruges, and Avignon. At the time, England exported wool that was critical to the textile industries of Italy and the Low Countries. Financing this trade required advances against shipments that might take months to arrive. According to account books that survive from the period, balances were settled through coordinated transfers across branch networks rather than isolated payments. Studies of these ledgers show a high degree of sophistication in double-entry bookkeeping. The introduction of systematic debits and credits allowed banks to track obligations across jurisdictions. This administrative innovation reduced errors and strengthened confidence in long-distance transactions. Merchant banks were not merely passive conduits for trade flows. They shaped commercial patterns by deciding which ventures to finance and under what terms. The mechanism of trade finance involved evaluating cargo quality, shipping reliability, and the political conditions of ports. The reason certain routes flourished was often tied to the willingness of banks to extend credit along them. This works because capital availability determined which merchants could scale operations beyond local markets. Banks pooled deposits from investors and redirected funds toward ventures promising returns. They diversified exposures by spreading loans across commodities such as wool, grain, and spices. When one sector experienced disruption, profits from another could offset losses. Risk management became an integral component of merchant banking practice. By the 15th century, maritime republics such as Venice had integrated public finance with private banking. At the time, the Venetian state borrowed from citizens through forced loans that were later tradable. These securities circulated alongside commercial paper, blurring the boundary between government debt and trade credit. According to legislative records, secondary markets for these obligations developed within decades. The presence of liquid instruments encouraged further financial experimentation. Merchant banks participated in underwriting and distributing state debt. This involvement strengthened their political influence and aligned private fortunes with public stability. The relationship between commerce and governance deepened as financial capacity expanded. The expansion of merchant banking gradually extended beyond Italy into Northern Europe. Cities such as Antwerp and Amsterdam became centers of trade finance in the 16th and 17th centuries. The mechanism of growth in these regions was linked to maritime trade with the Baltic and Atlantic worlds. The reason these cities attracted capital was their strategic location and relatively tolerant commercial policies. This works because merchants seek jurisdictions that protect contracts and enforce debts efficiently. According to economic historians, the concentration of skilled intermediaries lowered transaction costs for international exchange. Merchant banks coordinated shipments, insured cargoes, and arranged settlements across currencies. Their offices formed the connective tissue of an emerging global economy. As trade volumes increased and routes extended toward Asia and the Americas, the scale of required financing grew correspondingly. Merchant banks adapted by forming partnerships that pooled capital across families and regions. These partnerships were structured to distribute profits and losses according to predefined shares. The mechanism of partnership limited individual exposure while enabling larger ventures. The reason this structure endured was that it balanced trust with formal agreement. Capital could be mobilized quickly in response to new opportunities, whether in spice convoys or silver shipments. Over time, these financial techniques established patterns that would influence later joint stock companies and national banking systems. The architecture of merchant banking, built on correspondence, credit, and calculated risk, was laying foundations that would support ever wider circuits of exchange. The expansion of merchant banking did not eliminate uncertainty from long-distance commerce, but it reorganized how that uncertainty was managed and priced. As trade routes extended from the Mediterranean into the Atlantic, voyages grew longer and cargo values increased substantially. Ships sailing from Lisbon or Seville carried spices, silver, and textiles whose worth exceeded the annual income of many towns. Financing these expeditions required advances well before goods were sold. Merchant banks structured layered agreements that divided responsibility among shipowners, investors, and traders. Contracts specified delivery dates, quality standards, and repayment schedules in careful detail. Correspondence between branches recorded fluctuations in prices and political conditions. The financial house acted as a clearing center, translating distant events into adjustments of credit lines and exchange rates. Trade finance was becoming a continuous process rather than a single transaction. The mechanism of maritime insurance developed alongside merchant banking and reinforced its stability. The reason insurance contracts proved essential was that ocean transport exposed capital to storms, piracy, and war. This works because risk can be distributed across many investors rather than borne by one merchant alone. Banks often facilitated insurance syndicates, matching underwriters with traders seeking coverage. Premiums were calculated according to route, season, and geopolitical climate. According to surviving policies from 16th century Iberia, rates varied significantly depending on the presence of naval escorts. The integration of insurance with credit reduced the likelihood that a single catastrophe would bankrupt a trading house. Merchant banks could therefore extend larger loans with greater confidence. Financial innovation and maritime expansion advanced together in deliberate coordination. By the early 17th century, Northern European centers refined these practices further. In Amsterdam, the establishment of the Amsterdam Exchange Bank in 1609 provided a stable unit of account for commercial settlements. At the time, European markets were flooded with coins of varying weight and purity. Merchants faced constant uncertainty over the metallic content of payments. The new bank accepted deposits of coin and credited accounts in standardized bank money. By 1620, large-scale transactions in the city were routinely settled through transfers on its books. According to municipal ordinances, withdrawals in coin were restricted to preserve stability. The institution became a trusted anchor for bills of exchange circulating across the continent. Its presence strengthened the broader ecosystem of merchant banking. The mechanism behind this institutional stability rested on disciplined reserve management and public oversight. The reason the bank inspired confidence was its commitment to maintain full backing for deposits. This works because merchants are more willing to accept ledger transfers when redemption is credible. Merchant banks interacting with the exchange bank could clear balances efficiently without transporting specie. Settlement cycles shortened, and transaction costs declined. The availability of reliable bank money also facilitated secondary markets in bills of exchange. According to economic research on Dutch commerce, turnover in these instruments expanded rapidly after 1610. Financial liquidity allowed traders to adjust positions in response to changing information. The infrastructure of credit became both deeper and more resilient. Merchant banks also adapted to the rise of chartered trading companies operating on an unprecedented scale. Organizations such as the Dutch East India Company and the English East India Company required continuous financing for fleets, fortifications, and inventories. At the time, these enterprises blended private investment with quasi-sovereign authority. Shares were issued to a broad pool of investors, creating transferable ownership stakes. Merchant banks participated in underwriting these subscriptions and facilitating dividend payments. According to company archives, dividends were often paid partly in spices or other commodities rather than cash. Financial intermediaries translated these distributions into marketable value for shareholders. Trade finance was merging with early forms of corporate finance. The mechanism of underwriting joint stock ventures altered risk distribution within international trade. The reason it mattered was that individual merchants no longer bore full exposure to distant expeditions. This works because losses could be absorbed collectively by shareholders. Merchant banks assessed subscription levels and gauged investor appetite before voyages were launched. They priced shares based on anticipated returns from specific routes. Secondary trading in these shares generated new opportunities for speculation and liquidity management. According to studies of 17th-century Amsterdam markets, price fluctuations reflected news of ship arrivals and cargo quality. Financial information traveled faster than ships themselves through letters and rumor networks. Banks occupied a central position in interpreting and acting upon that information. By the late 17th century, merchant banking had become embedded in state finance as well as private trade. Governments in England and the Dutch Republic relied on commercial intermediaries to raise funds for war and infrastructure. At the time, military conflict required sustained revenue streams beyond ordinary taxation. Merchant banks organized syndicated loans and managed bond distributions among investors. According to parliamentary records in London, subscription campaigns were often coordinated through established financial houses. The blending of public debt management with trade finance expanded the scale of banking operations. It also deepened the interdependence between political stability and commercial credit. Financial reputation became a matter of national as well as private concern. As these institutions matured, their practices grew increasingly standardized across regions. Letters of credit, bills of exchange, insurance policies, and share certificates circulated within overlapping networks. Merchant banks codified procedures for verifying signatures and authenticating seals. The mechanism of trust depended on consistent documentation and disciplined accounting. The reason these conventions endured was their capacity to reduce ambiguity in complex transactions. This works because clarity lowers the cost of enforcement and dispute resolution. Over time, trade finance evolved from a set of localized customs into an interconnected European system. Its principles would later inform the architecture of central banking and modern international settlement, carrying forward the logic of credit across expanding horizons of exchange. By the early 18th century, merchant banking networks had stretched across Europe and into the Atlantic world, forming durable channels of capital movement. Financial houses in London, Amsterdam, and Hamburg coordinated settlements that linked plantation economies, mining regions, and manufacturing centers. At the time, the volume of correspondence required to manage these relationships increased dramatically. Couriers carried packets of letters detailing prices, exchange rates, shipping schedules, and political developments. Merchant banks became information processors as much as capital providers. Their clerks compiled ledgers that mapped obligations across continents. The reliability of these records determined whether credit could be extended with confidence. Trade finance was now inseparable from the systematic management of data and reputation. The mechanism of correspondent banking emerged as a formalized extension of earlier branch systems. The reason it proved effective was that banks could maintain accounts with trusted partners abroad rather than establish costly physical offices everywhere. This works because balances could be offset through reciprocal entries instead of transferring bullion. A merchant bank in London might hold funds on behalf of a partner in Hamburg, while that partner held equivalent balances for London clients. According to surviving 18th century account books, such reciprocal arrangements reduced the need for specie shipments. Settlement occurred through periodic reconciliation of books. The network effect strengthened as more institutions joined these arrangements. Credit flowed along lines defined by mutual trust and documented performance. By 1694, the founding of the Bank of England marked a turning point in the relationship between merchant banking and state finance. At the time, England faced heavy military expenditures that required reliable long-term borrowing. The new institution issued notes backed by government debt, creating a standardized instrument accepted in commercial transactions. Merchant banks quickly integrated these notes into their settlement practices. According to parliamentary debates of the period, confidence in public credit stabilized private markets. Bills of exchange drawn on London gained additional credibility because they operated within a system anchored by a national bank. The boundary between merchant finance and central banking began to narrow. The mechanism linking public debt to private trade rested on liquidity and convertibility. The reason government securities supported commerce was that they provided widely accepted collateral. This works because assets perceived as stable can underpin short-term credit arrangements. Merchant banks held public bonds that could be pledged against loans or sold to meet obligations. The circulation of banknotes simplified transactions among traders operating at scale. According to economic historians, London's rise as a financial center accelerated during the 18th century partly due to this integration. Markets for government debt, bills of exchange, and insurance policies overlapped within the same urban space. Financial specialization deepened while systemic interdependence increased. In continental Europe, similar dynamics unfolded with regional variations. In Paris, experiments with paper money and banking during the early 18th century produced episodes of instability. At the time, speculative excess and weak regulatory structures undermined confidence. Merchant banks responded by tightening credit standards and diversifying exposures geographically. According to contemporary pamphlets and correspondence, trust once damaged required sustained demonstration of solvency to restore. These experiences reinforced the importance of disciplined balance sheet management. Financial houses learned to monitor leverage ratios and maintain reserves against unexpected withdrawals. The lessons of crisis were gradually incorporated into routine practice. The mechanism of discounting bills of exchange became central to daily operations in mature merchant banking systems. The reason discounting mattered was that it converted future payments into immediate liquidity. This works because a banker could purchase a bill at less than its face value, earning a margin upon maturity. Merchants benefited by receiving funds before goods were fully sold or accounts settled. According to archival studies of London and Amsterdam markets, discount rates fluctuated in response to harvest outcomes, war news, and shipping delays. Banks adjusted these rates to reflect perceived risk and demand for funds. The practice linked short-term credit conditions directly to broader economic developments. Trade finance thus became sensitive to cycles of optimism and contraction. As the 18th century progressed, merchant banks increasingly served as intermediaries for international investment flows. Capital accumulated in commercial centers was directed toward infrastructure, mining ventures, and colonial enterprises. The mechanism of capital export depended on trust in distant legal systems and enforcement mechanisms. The reason investors participated was the expectation of returns exceeding domestic opportunities. This works because diversification across regions could reduce exposure to local downturns. According to records of bond issues and partnership agreements, merchant banks structured contracts specifying currency of payment and jurisdiction for dispute resolution. These arrangements reduced uncertainty in cross-border commitments. Financial globalization was taking shape through practical adaptation rather than grand design. By the close of the century, the architecture of merchant banking had achieved a level of sophistication that would shape 19th century finance. Networks of correspondence, standardized instruments, public debt markets, and discount facilities formed an integrated system. The mechanism sustaining this system was cumulative trust built through repeated performance and transparent accounting. The reason it endured was its flexibility in reallocating capital across sectors and regions in response to shifting conditions. This works because credit can expand or contract without requiring physical relocation of resources. Merchant banks stood at the center of this adaptive structure, coordinating information, capital, and risk across expanding geographies. Their methods would inform the evolution of modern international banking, as industrialization and empire introduced new scales of demand and complexity. In earlier eras of commerce, merchants confronted a persistent challenge that extended beyond distance and language. The transfer of value across borders required mechanisms that could bridge political boundaries and reduce the physical risks of transport. Precious metals such as gold and silver had intrinsic value, yet moving them exposed traders to theft, loss, and fluctuating local standards. As trade networks expanded across the Mediterranean and into Northern Europe, settlement systems evolved to address these vulnerabilities. By the late medieval period, merchant communities in cities such as Venice and Florence had developed sophisticated practices for clearing obligations without physically transferring coin. These practices relied on trust, reputation, and written instruments that represented claims on distant funds. The mechanism allowed merchants to settle accounts through book entries maintained by banking houses rather than through the shipment of bullion. This approach reduced transaction costs and compressed settlement time, even when communication remained slow. Over time, these localized solutions formed the foundation of international banking architecture. The Bill of Exchange became one of the most influential tools in this transformation. It functioned as a written order directing one party to pay a specified sum to another party at a future date in a different location. The reason this instrument gained acceptance was that it separated the act of payment from the movement of metal currency. A merchant in one city could deposit funds with a banking house and receive a bill payable in another commercial center. The receiving merchant would present the bill to the designated correspondent and obtain local currency. This worked because networks of banking families maintained reciprocal accounts with one another, allowing them to offset obligations internally. The mechanism effectively created a multilateral clearing system based on mutual trust and detailed record keeping. According to commercial records from the period, disputes were rare when reputational incentives remained strong. By reducing the need to transport specie, the Bill of Exchange accelerated trade across political boundaries. Its widespread adoption reshaped the way value moved through Europe and beyond. By the 15th century, Italian banking families such as the Medici Bank had formalized correspondent relationships across major trading hubs. At the time, exchange rates between currencies were not fixed by central authorities but determined through negotiation and market practice. Banking houses maintained ledgers that tracked balances owed to and from partners in cities including London and Bruges. These ledgers allowed obligations to be netted against one another, reducing the volume of physical transfers required. By 1500, fairs in cities such as Lyon had become important clearing centers where merchants reconciled accounts periodically. At these gatherings, large volumes of bills were settled through offsetting entries rather than coin payments. The system relied on predictable cycles and face-to-face verification of balances. Historical accounts show that these fairs functioned as proto-clearinghouses in an era without centralized oversight. They provided structure to cross-border settlement at a time when sovereign monetary systems remained fragmented. As trade expanded beyond Europe during the 16th and 17th centuries, settlement methods adapted to longer distances and greater uncertainty. The rise of maritime empires connected Europe with Asia, Africa, and the Americas, creating more complex payment chains. Merchant companies such as the Dutch East India Company and the British East India Company operated across multiple currencies and jurisdictions. The mechanism of settlement increasingly depended on centralized accounting in metropolitan financial centers. This worked because colonial outposts remitted revenues and commodities that could be valued and credited against obligations abroad. According to archival research, these companies often used bills drawn on headquarters in Amsterdam or London to settle distant debts. The bills circulated among merchants as reliable instruments backed by powerful institutions. Over time, the credibility of these companies strengthened confidence in cross-border paper claims. Settlement practices thus became intertwined with imperial administration and global trade flows. The 18th century witnessed further institutional refinement as banking systems grew more interconnected. The emergence of central banks introduced new layers of stability to domestic payment systems. Institutions such as the Bank of England provided a reference point for currency credibility and liquidity management. The reason this mattered for cross-border settlement was that foreign counterparties evaluated the strength of a currency based on its issuer. When domestic banks held reserves in central bank money, their obligations gained additional reliability. The mechanism of correspondent banking expanded as institutions opened accounts with one another to facilitate international payments. This worked because balances could be transferred through ledger adjustments between correspondents rather than through shipping specie. Studies show that by the late 18th century, London had become a dominant clearing center for global trade finance. Its legal framework and financial depth attracted foreign banks seeking secure settlement channels. The structure of international payments increasingly revolved around concentrated financial hubs. During the 19th century, technological advances reshaped the tempo of cross-border settlement. The telegraph allowed information about balances and exchange rates to travel rapidly between continents. By 1866, the successful laying of the transatlantic cable connected financial markets in London and New York City. At the time, This innovation reduced uncertainty associated with delayed communication about payment confirmation. Banks could adjust positions and settle accounts more frequently, limiting exposure to exchange risk. The mechanism of gold standard settlement also influenced cross-border flows. This worked because currencies were defined in terms of fixed quantities of gold, creating predictable exchange relationships. According to economic historians, the classical gold standard period saw a high degree of integration in capital markets. Central banks cooperated informally to manage gold flows and maintain convertibility. Settlement systems thus operated within a framework that combined technological speed with monetary discipline. By the early 20th century, the scale of international finance demanded more formalized clearing arrangements. Wars and economic disruptions exposed weaknesses in decentralized correspondent networks. The reason was that political shocks could interrupt communication and undermine trust among counterparties. In response, banks and governments sought mechanisms to stabilize settlement flows across borders. Multilateral institutions and clearing agreements emerged to reduce reliance on bilateral trust alone. According to historical studies, interwar experiments with clearing unions aimed to conserve scarce foreign exchange reserves. These arrangements recorded trade imbalances and postponed final settlement, allowing economies to continue exchanging goods despite currency shortages. The mechanism demonstrated that cross-border settlement could be coordinated at a systemic level rather than solely through private relationships. Over time, these innovations laid groundwork for more comprehensive post-war financial architectures. The evolution of settlement methods reflected an ongoing effort to balance trust, efficiency, and sovereignty in an interconnected world. As international finance matured in the 20th century, cross-border settlement methods became increasingly institutionalized and standardized. The expansion of global trade after the First World War placed strain on older correspondent networks that depended heavily on bilateral trust. Governments recognized that private arrangements alone could not sustain stable settlement flows during periods of economic stress. The interwar years saw experiments with exchange controls, bilateral clearing agreements, and currency blocks designed to conserve foreign reserves. The mechanism of bilateral clearing worked by recording exports and imports in centralized accounts, allowing deficits to accumulate without immediate gold transfers. This worked because countries facing currency shortages could postpone final settlement while continuing trade within defined limits. According to economic historians, such arrangements reduced short-term pressure on gold reserves but constrained multilateral commerce. By concentrating flows within political alliances, clearing agreements altered the geography of trade. The experience demonstrated that settlement systems could be shaped as much by state policy as by market practice. The conclusion of the Second World War produced a more comprehensive framework for monetary cooperation. In 1944, representatives of 44 nations met in Bretton Woods to design a new international financial order. The agreements established fixed exchange rates anchored to the United States dollar, which was convertible into gold at a set price. The reason this structure mattered for settlement was that predictable exchange rates reduced uncertainty in cross-border payments. Central banks maintained dollar reserves and intervened in foreign exchange markets to preserve parity. This worked because the dollar functioned as a widely accepted reserve asset, enabling countries to settle imbalances through transfers of dollar claims. According to archival records, the system relied heavily on the credibility of the United States' commitment to gold convertibility. Multilateral institutions were created to monitor compliance and provide short-term financing. Settlement practices became embedded within a rules-based international architecture. During the Bretton Woods era, correspondent banking expanded further under the umbrella of dollar liquidity. Commercial banks around the world opened accounts with institutions in New York City to facilitate dollar-denominated transactions. The mechanism of correspondent banking involved maintaining reciprocal nostro and vostro accounts that recorded cross-border balances. This worked because banks could instruct their correspondents to debit or credit accounts without moving physical currency. The rise of the eurodollar market in the 1950s added another layer of complexity to settlement flows. Dollars held outside the United States circulated through offshore banking centers, particularly in London. Studies show that this offshore market increased the supply of dollar liquidity available for trade finance and investment. By the late 1960s, cross-border payment volumes had grown significantly as multinational corporations expanded operations. Settlement systems were increasingly dependent on electronic communication and centralized bookkeeping rather than paper instruments. Technological change accelerated the evolution of cross-border settlement in the late 20th century. The replacement of telex messages with computerized messaging systems reduced errors and improved speed. In 1973, banks from 15 countries founded the Society for Worldwide Interbank Financial Telecommunication to create a standardized global messaging network. The mechanism of SWIFT did not transfer funds directly but transmitted secure payment instructions between financial institutions. This worked because standardized message formats minimized ambiguity and facilitated automated processing. According to industry data, SWIFT membership expanded rapidly as banks recognized the efficiency gains of unified communication protocols. By the 1980s, millions of payment messages were transmitted annually across continents. Settlement times shortened as instructions moved electronically rather than by courier. The infrastructure of cross-border payments became increasingly digital and interconnected. Parallel to messaging innovation, central banks enhanced their oversight of international liquidity. The Bank for International Settlements played a coordinating role among monetary authorities. Through regular meetings and data collection, it monitored cross-border exposures and settlement risks. The reason this coordination mattered was that large payment flows created systemic vulnerabilities if disrupted. Settlement risk arose when one party delivered currency while awaiting counterpayment in another time zone. This worked because differences in operating hours could leave institutions exposed to losses if counterparties failed. Studies of payment crises in the 1970s highlighted the importance of synchronized settlement mechanisms. In response, central banks encouraged the development of real-time gross settlement systems for domestic payments. These domestic reforms influenced the structure of international settlement by improving the reliability of underlying currencies. The collapse of the Bretton Woods system in 1971 introduced floating exchange rates and greater currency volatility. Cross-border settlement methods had to adapt to more frequent price fluctuations in foreign exchange markets. The mechanism of foreign exchange settlement typically involved simultaneous exchanges of two currencies between counterparties. This worked because dealers agreed on a spot rate and instructed their correspondent banks to credit respective accounts. However, time zone differences created principal risk, later termed Herstatt risk after a bank failure in 1974. According to regulatory analyses, this event exposed weaknesses in the timing of settlement across currencies. Financial institutions responded by developing netting arrangements and multilateral clearing systems to reduce exposure. The growth of derivatives markets further increased the volume and complexity of settlement flows. International banking entered an era characterized by high-speed transactions and heightened attention to operational resilience. By the late 20th and early 21st centuries, globalization intensified interdependence among financial centers. Payment systems became integrated with securities settlement, trade finance platforms, and capital market infrastructures. The mechanism of continuous linked settlement emerged to address foreign exchange settlement risk by synchronizing payments across currencies. This worked because participating banks settled obligations simultaneously through a centralized platform, reducing principal exposure. According to industry reports, such systems processed trillions of dollars in transactions daily. Advances in data processing enabled near real-time monitoring of cross-border positions. Regulatory reforms after the global financial crisis strengthened capital and liquidity standards for internationally active banks. Settlement architecture increasingly reflected a balance between efficiency and prudential oversight. The ongoing refinement of cross-border payment mechanisms continued to shape the structure of international banking as financial integration deepened across regions and markets. At the beginning of the 21st century, cross-border settlement entered a phase defined by scale, speed, and continuous operation. Global trade volumes expanded alongside complex capital flows linking banks, corporations, and sovereign institutions. Settlement systems that once processed paper instruments now managed vast streams of digital instructions every second. The mechanism underlying modern international payments relies on layered infrastructures combining messaging networks, correspondent accounts, and central bank settlement systems. This works because each layer performs a distinct function while interfacing with the others through standardized protocols. According to industry assessments, daily foreign exchange turnover reached trillions of dollars, requiring highly coordinated settlement cycles. Time zone differences remain central to operational design, as payment obligations pass from Asia to Europe to North America in a continuous sequence. Financial institutions manage liquidity buffers across currencies to ensure timely completion of obligations. The architecture of settlement has become both global and deeply interdependent. One important development has been the integration of securities and payment settlement within centralized infrastructures. Systems such as Target2 in the euro area connect commercial banks directly to the balance sheets of the European Central Bank. The reason this matters for cross-border settlement is that large value payments in euros can be finalized in central bank money with immediate legal certainty. This works because real-time gross settlement eliminates credit exposure between participants once payment is executed. Similar frameworks exist in other jurisdictions, linking domestic systems into broader international networks. According to central bank publications, harmonized standards reduce operational friction when transactions involve multiple currencies. Securities settlement platforms have also adopted delivery versus payment mechanisms to synchronize asset transfers with cash movements. The consolidation of these infrastructures has lowered systemic risk while increasing transparency. Cross-border settlement now depends on coordinated public and private governance structures. Foreign exchange settlement risk has been further reduced through multilateral mechanisms designed specifically for currency transactions. Continuous linked settlement systems coordinate simultaneous payment of currency pairs across participating banks. This works because both legs of a transaction settle only if sufficient balances are available in each currency. The mechanism removes the principal risk that once arose when one party paid while awaiting counterpayment. According to market data, a significant share of global foreign exchange trades now pass through such synchronized platforms. Participation requires adherence to strict liquidity and collateral standards, reinforcing prudential discipline. The concentration of settlement within centralized systems has prompted careful oversight by regulators concerned with operational resilience. Stress testing and contingency planning are now integral components of cross-border payment governance. The design reflects lessons drawn from earlier episodes of market disruption and institutional failure. Beyond traditional banking channels, new payment technologies have introduced additional layers to international settlement. Digital payment providers offer cross-border transfers that bypass parts of the conventional correspondent model. The mechanism typically involves pre-funding local accounts in multiple jurisdictions and netting transactions internally. This works because customer payments can be matched within the provider's own ledger before final settlement occurs through domestic banking systems. According to fintech industry reports, such models reduce costs and shorten transfer times for retail users. However, final settlement still depends on underlying bank accounts and central bank money. Regulatory authorities have responded by clarifying licensing and capital requirements for non-bank payment firms. The boundary between banking and payment services has become more fluid, yet settlement finality remains anchored in established monetary institutions. The evolution illustrates continuity beneath visible technological change. Distributed ledger technology has also been explored as a potential tool for cross-border settlement. Pilot projects conducted by central banks examine whether tokenized representations of currency could facilitate atomic payment across jurisdictions. The mechanism involves synchronizing transfers on shared digital ledgers so that both sides of a transaction update simultaneously. This works because consensus protocols validate each transaction before it becomes final and immutable. According to research papers issued by monetary authorities, such systems may reduce reconciliation costs and improve transparency. Yet practical implementation faces legal, technical, and governance challenges. Questions persist regarding interoperability between national systems and the preservation of monetary sovereignty. Experimental platforms remain limited in scope compared to established infrastructures. Even so, they signal ongoing efforts to refine the mechanics of global settlement. Geopolitical developments have also influenced the structure of cross-border payment networks. Sanctions regimes and financial restrictions have demonstrated how access to messaging and clearing systems can be leveraged as instruments of state policy. The prominence of the United States dollar has meant that transactions clearing through institutions connected to the Federal Reserve System fall within its jurisdictional reach. The reason this is significant lies in the central role of dollar settlement in global trade and finance. This works because many international contracts are denominated in dollars regardless of the location of the parties involved. According to international monetary statistics, dollar assets constitute a large share of global reserves. Efforts by some countries to diversify settlement currencies reflect strategic considerations as well as economic ones. Alternative messaging systems and regional clearing arrangements have been proposed to reduce reliance on dominant networks. The interplay between finance and geopolitics continues to shape settlement architecture. Risk management has become a defining feature of contemporary cross-border settlement systems. Financial institutions must monitor intraday liquidity positions across multiple currencies and jurisdictions. The mechanism involves sophisticated forecasting models that anticipate payment inflows and outflows throughout the day. This works because timely information allows banks to allocate funds efficiently and avoid costly overdrafts. According to supervisory guidelines, stress scenarios are used to test resilience against market shocks or operational failures. Cybersecurity has emerged as a critical concern given the digital nature of modern payment infrastructure. Coordinated frameworks among central banks and private institutions aim to strengthen defenses and share intelligence. Transparency requirements have increased, with reporting obligations designed to illuminate cross-border exposures. Settlement systems are no longer viewed merely as technical utilities but as core components of financial stability. As international banking systems continue to evolve, cross-border settlement remains both foundational and dynamic. The essential objective persists, which is the reliable transfer of value across political and monetary boundaries. The mechanism has shifted from handwritten bills of exchange to instantaneous digital instructions, yet the underlying logic of trust and verification endures. This works because participants must believe that recorded balances correspond to enforceable claims. According to long-term historical analysis, each era adapts settlement techniques to prevailing technologies and institutional arrangements. The accumulation of incremental improvements has produced a dense web of interconnected payment pathways. Future innovations will likely integrate further automation and data analytics into settlement processing. Structural tensions between efficiency, security, and sovereignty will continue to influence design choices. Within this evolving landscape, the movement of value across borders remains a central function of the global financial system. The expansion of international trade in the early modern period required mechanisms that could bridge distance, time, and uncertainty. Gold and silver moved across borders as final settlement, but the physical shipment of bullion was slow, costly, and vulnerable to loss. Merchants therefore relied increasingly on paper instruments that represented claims rather than metal itself. Bills of exchange became the central device through which obligations were created, transferred, and ultimately balanced. These instruments allowed a merchant in one city to pay a supplier in another without physically transporting coin. The credibility of the system rested on reputation, trust, and the expectation that debts would be honored at maturity. As commercial centers multiplied across Europe and later across the Atlantic, the circulation of these bills created a web of financial interdependence. Gold remained the ultimate anchor, yet day-to-day commerce depended more on signatures than on bullion. The architecture of international banking began to take shape within this practical compromise between metal and paper. By the 17th century, major trading cities such as Amsterdam and London had developed sophisticated markets for discounting bills of exchange. At the time, merchants routinely drew bills payable several months in the future, reflecting the duration of sea voyages and overland transport. A bill drawn in one port might pass through many hands before maturity, each endorsement adding another layer of guarantee. By 1700, specialized bankers had emerged whose primary business was accepting and discounting these instruments. The growth of colonial trade in the 18th century further expanded this practice, linking Europe with the Americas, Africa, and Asia. Bills denominated in different currencies circulated simultaneously, requiring constant calculation of exchange rates. Political events such as wars or embargoes often disrupted these flows, yet the underlying structure persisted. The increasing standardization of documentation and accounting practices reduced ambiguity in cross-border transactions. International banking thus evolved not from grand design but from incremental adaptation to commercial necessity. The mechanism of a bill of exchange was straightforward but powerful. A merchant known as the drawer ordered another party, the drawee, to pay a specified sum to a third party at a future date. This worked because all participants operated within a network where reputation determined access to credit. The reason bills could circulate widely was that each endorsement transferred not only ownership but also liability. If the drawee failed to pay at maturity, prior endorsers could be called upon to settle the obligation. This chain of contingent responsibility reduced the risk borne by any single participant. Discounting allowed holders to convert a future payment into immediate cash at a small deduction reflecting time and risk. The price of a bill therefore incorporated expectations about interest rates, political stability, and the standing of the accepting house. In effect, the bill market translated dispersed information about trust into a financial instrument that could travel across borders. Gold nevertheless remained central as the ultimate means of settlement between banking houses. When imbalances accumulated between cities, bullion shipments corrected the difference. The reason gold retained this role was that it carried intrinsic value recognized across political boundaries. This works because metal could extinguish debts without relying on the solvency of any intermediary. Periodic shipments of coin or bullion balanced accounts between correspondent banks in different countries. These transfers were often netted against multiple claims, minimizing the volume of metal that actually moved. Exchange rates fluctuated within narrow bands determined by the cost of shipping gold, a concept later described as the gold points. When rates moved beyond those bounds, arbitrageurs found profit in exporting or importing bullion. The interplay between paper claims and metallic settlement created a disciplined yet flexible international payment system. Correspondent banking relationships emerged to manage these complex flows. A bank in one city would maintain an account with a partner institution abroad, holding balances in local currency. These correspondents acted as agents, collecting payments, honoring drafts, and providing information about market conditions. According to contemporary trade manuals, merchants preferred banks with extensive foreign correspondence because settlement became faster and more predictable. Studies show that by the 19th century, major banking houses maintained dozens of such relationships across continents. The network effect strengthened leading financial centers, concentrating liquidity where information was richest. Smaller banks relied on these hubs to access international markets, reinforcing hierarchical structures. Trust between correspondents was formalized through regular account statements and periodic reconciliation of balances. Over time, these bilateral ties formed a dense lattice that underpinned global commerce. The historical consolidation of these practices accelerated during the 19th century with the formal adoption of the gold standard. By 1870, countries such as United Kingdom had long operated on a de facto gold basis, while others gradually aligned their currencies with fixed gold parities. At the time, adherence to gold signaled fiscal discipline and facilitated predictable exchange rates. By 1900, most major trading nations had committed to convertibility, creating a relatively stable international monetary environment. Bills of exchange drawn in sterling, francs, or marks circulated with confidence because their value could be traced back to defined quantities of gold. Central banks began to coordinate policies to maintain convertibility during periods of stress. Financial crises still occurred, yet the expectation of gold redemption imposed constraints on excessive expansion. The system reached its peak integration on the eve of the First World War. The interaction between gold, bills, and correspondent banks created a layered system of risk distribution. Short-term trade finance rested on private signatures and commercial judgment. The mechanism linking these signatures to metal reserves imposed an external discipline that limited overextension. This works because persistent deficits would eventually drain gold from a country, forcing adjustment through interest rates or reduced imports. Correspondent banks monitored these pressures closely, adjusting credit lines in response to shifting balances. The reason confidence endured for decades was that participants believed rules would be honored even during temporary strain. Informal cooperation among leading houses supplemented formal legal frameworks. Communication technologies such as the telegraph accelerated information flows, tightening the integration of markets. By the early 20th century, international banking had become a coordinated system rather than a collection of isolated practices. This system did not eliminate uncertainty, but it provided structure to an expanding world economy. Gold shipments settled ultimate balances, while bills of exchange lubricated everyday trade. Correspondent banks translated distant obligations into local entries on account books. The cumulative effect was a payments network capable of supporting industrial-scale commerce across oceans. Capital moved toward regions offering higher returns, financed through familiar instruments rather than experimental devices. Periodic crises tested the resilience of the arrangement, yet its core principles proved durable. Even as political tensions mounted in the early 20th century, the habits of settlement continued to guide transactions. The architecture of international banking stood on the interdependence of metal, paper, and trust, a balance that would soon confront unprecedented strain. As trade volumes expanded during the 19th century, the scale of bill circulation increased dramatically. Commercial houses in port cities relied on acceptance credit to finance shipments that could take months to complete. An accepting bank would guarantee payment of a merchant's bill in exchange for a fee, effectively substituting its reputation for that of the drawer. This arrangement allowed goods to move before final buyers had paid, smoothing the rhythm of commerce. Acceptance houses in London became especially prominent because sterling bills were widely trusted. The depth of the London discount market meant that a bill accepted there could be sold quickly for cash. Liquidity attracted more participants, reinforcing the city's dominance in international settlements. Similar, though smaller, markets developed in Paris, Hamburg, and New York as industrialization progressed. The circulation of accepted bills became a cornerstone of global trade finance. The mechanism of acceptance credit redistributed risk across multiple layers of the banking system. A merchant drew a bill on an accepting bank, which agreed to honor it at maturity. This worked because the bank conducted careful assessments of the merchant's reliability and collateral. Once accepted, the bill carried the bank's signature, transforming it into a highly marketable instrument. Investors seeking short-term returns purchased these bills at a discount, confident in the standing of the acceptor. The reason the system expanded was that it aligned incentives among merchants, banks, and investors. Banks earned fees without tying up large amounts of capital, while investors gained access to relatively safe assets. The structure resembled a chain in which each participant assumed a defined portion of risk. Such specialization increased efficiency but also interconnected balance sheets across borders. By the late 19th century, telegraphic communication had tightened the coordination among correspondent banks. At the time, exchange rates were quoted daily across major financial centers, reflecting supply and demand for different currencies. Rapid transmission of information reduced arbitrage opportunities and narrowed price discrepancies. By 1890, major banks could instruct foreign correspondents within hours rather than weeks. This acceleration strengthened the gold standard by enabling swift responses to balance of payments pressures. When gold began to flow out of one country, interest rates could be adjusted promptly to attract funds back. The discipline imposed by convertibility thus operated through both market signals and institutional cooperation. Financial newspapers published detailed tables of rates, bullion movements, and discount levels. The transparency of information contributed to a shared understanding of prevailing conditions. Gold flows themselves followed predictable channels shaped by cost and confidence. When exchange rates moved beyond the gold export point, merchants found it profitable to ship bullion abroad. The mechanism depended on comparing the expense of transporting metal with the premium available in foreign exchange markets. This works because even small deviations from parity could yield gains if volumes were large enough. Banks often arranged insurance and freight in advance, reducing logistical uncertainty. Correspondent institutions prepared to receive shipments and credit accounts accordingly. The reason gold movements were intermittent rather than constant was that most imbalances were settled through paper offsets. Only persistent deficits or surpluses triggered substantial transfers of metal. The periodic arrival of bullion shipments nonetheless served as a visible reminder of the system's foundation. According to economic historians, the pre-war gold standard fostered a high degree of capital mobility. Studies show that investors in Britain and France directed funds toward railways, mines, and infrastructure projects across the Americas and Asia. These investments were often financed through bills and correspondent accounts that linked borrowers to European capital markets. The credibility of gold convertibility reduced fears of currency depreciation. As a result, long-term lending expanded alongside short-term trade finance. Banks assessed sovereign risk as carefully as commercial credit, recognizing that political instability could disrupt repayment. The interweaving of public and private finance deepened the reach of international banking networks. Capital exporting countries accumulated foreign assets, while recipient regions integrated more closely into global trade circuits. The structure of correspondent banking became increasingly hierarchical during this era. Smaller regional banks maintained accounts with larger national institutions, which in turn held balances with dominant international centers. This layered arrangement concentrated reserves in a few pivotal cities. The mechanism allowed peripheral institutions to access foreign exchange without directly managing gold shipments. This works because balances could be adjusted through book entries across interconnected accounts. However, reliance on central hubs created vulnerabilities if confidence in those hubs weakened. Liquidity pressures in a major center could cascade outward through correspondent chains. The reason stability persisted for decades was that leading banks often cooperated informally during periods of strain. Mutual support agreements and shared norms reinforced the expectation that obligations would be honored. Financial crises nevertheless exposed the fragility underlying apparent order. The Panic of 1890, triggered by the near collapse of a major London house, reverberated through correspondent networks worldwide. At the time, central banks and private institutions coordinated emergency measures to prevent broader failure. Gold reserves were mobilized, and credit was extended to stabilize markets. By acting collectively, leading institutions preserved confidence in sterling bills and in gold convertibility. The episode demonstrated that the system required active management rather than passive adherence to rules. Market discipline alone could not contain panic once trust eroded. Cooperation among banks became an implicit pillar supporting the formal structure of the gold standard. As the 20th century approached, the integration of gold, bills, and correspondent relationships reached a sophisticated equilibrium. Trade finance, capital investment, and currency exchange operated within a coherent framework anchored by metallic convertibility. Yet the very density of connections meant that shocks could propagate rapidly across continents. Industrial economies depended on continuous access to short-term credit and stable exchange rates. Political tensions and competitive rivalries were beginning to strain diplomatic relations among major powers. Financial networks remained outwardly resilient, sustained by routines developed over generations. The balance between private initiative and institutional discipline held firm, even as the global environment grew more uncertain and complex. The outbreak of the First World War in 1914 abruptly disrupted the intricate balance that had governed international banking for decades. Gold convertibility was suspended in many countries as governments prioritized military expenditure over monetary discipline. Bills of exchange that once circulated with quiet confidence suddenly carried heightened uncertainty. Correspondent banks faced delayed communications, blocked payments, and the freezing of foreign balances. The mechanism that linked paper claims to metallic settlement weakened as gold exports were restricted or prohibited. This worked temporarily to conserve reserves, but it undermined the credibility of fixed exchange rates. Financial markets closed for extended periods, interrupting the continuous discounting of trade paper. The interwar years that followed were marked by attempts to restore pre-war arrangements under altered political and economic conditions. The earlier equilibrium between gold, bills, and correspondence had been fundamentally shaken. By the early 1920s, policymakers sought to reconstruct the gold standard in a world transformed by debt and inflation. At the time, several European economies faced depreciated currencies and heavy reparations obligations. By 1925, the United Kingdom formally returned to gold at the pre-war parity under the guidance of policymakers determined to reassert financial leadership. The decision restored nominal convertibility but imposed deflationary pressure on domestic industries. Other countries adopted modified gold exchange standards, holding reserves partly in foreign currencies rather than exclusively in bullion. This arrangement depended on confidence in reserve centers such as London and New York. Central banks coordinated through conferences and informal contacts to stabilize exchange rates. The restored system functioned unevenly, constrained by structural imbalances left unresolved after the war. The mechanism of the interwar gold exchange standard differed subtly from its predecessor. Countries maintained gold reserves but also held deposits in key currencies to economize on bullion. This worked because reserve currencies were themselves convertible into gold, at least in principle. The reason the structure was fragile lay in its reliance on layered promises rather than direct metal backing. If confidence in a reserve center declined, peripheral holders could simultaneously demand conversion. Such pressure would strain gold stocks and force abrupt policy adjustments. Correspondent banks monitored these dynamics closely, adjusting credit lines as rumors and data circulated. Capital flows became more volatile, reacting swiftly to changes in interest differentials and political developments. The system required careful management to prevent destabilizing surges of funds. The global financial crisis that began in 1929 exposed the limitations of the restored framework. According to contemporary observers, declining trade volumes reduced the demand for bills of exchange and compressed banking profits. Studies show that falling commodity prices and rising unemployment intensified fiscal stress across industrial economies. Banks faced mounting loan defaults, weakening their balance sheets. As confidence deteriorated, gold outflows accelerated from countries perceived as vulnerable. The mechanism linking exchange rates to metal reserves forced governments to choose between deflation and devaluation. Several nations abandoned gold in the early 1930s, prioritizing domestic stability over fixed parities. The collapse of coordinated convertibility fragmented the international payment system. Correspondent banking networks contracted as capital controls and exchange restrictions proliferated. Governments imposed licensing requirements and multiple currency practices to conserve scarce reserves. This worked by limiting private actors' ability to transfer funds freely across borders. The reason such measures spread was that policymakers feared rapid depletion of gold and foreign exchange. Banks adjusted by focusing more heavily on domestic lending and by navigating complex regulatory environments. International trade continued, but settlement mechanisms became more cumbersome and politically mediated. Clearing agreements between states replaced some market-based transactions. The fluid circulation of accepted bills gave way to bilateral arrangements negotiated at official levels. By the late 1930s, the once integrated system of gold-anchored finance had largely dissolved. At the time, only a few countries maintained formal convertibility, and even these operated under significant constraints. Correspondent relationships persisted, but their scope narrowed amid geopolitical tension. The outbreak of the Second World War further centralized financial authority within national governments. Gold reserves were mobilized to support war expenditures and to secure imports of critical materials. Private discount markets played a diminished role as states directed credit towards strategic objectives. International banking survived, yet it functioned within a framework shaped primarily by political imperatives. The experience of instability during the interwar period influenced post-war planning efforts. Policymakers concluded that uncoordinated adherence to gold had amplified economic downturns. The mechanism they envisioned after 1945 sought to balance exchange rate stability with greater flexibility for domestic policy. This worked by combining fixed but adjustable parities with institutional oversight. The reason such reform gained support was the widespread recognition that confidence required both rules and cooperation. New multilateral institutions were proposed to provide liquidity and surveillance. Correspondent banking would continue, but within a system designed to prevent destructive competition for reserves. Lessons drawn from earlier crises informed the architecture of the emerging order. As the Second World War drew to a close, financial leaders prepared to redefine the foundations of international settlement. Gold would remain significant, yet its role would be mediated through collective agreements rather than automatic flows. Bills of exchange would persist in trade finance, adapted to new regulatory contexts. Correspondent banks would once again connect markets, though under closer supervision. The accumulated experience of suspension, restoration, and collapse had reshaped expectations about stability. International banking had evolved through cycles of trust and disruption, each leaving institutional traces. The next chapter would build upon these foundations, seeking durability in a world still marked by uncertainty and reconstruction. By the late 17th century, the financial networks described in earlier chapters had grown dense, fragile, and increasingly political. Merchant banks moved capital across borders with growing speed, yet sovereign governments still struggled to finance wars and manage public debt. The scale of European conflict required sums that exceeded the capacity of traditional tax systems. At the same time, expanding trade demanded a more stable monetary foundation than scattered coinage and private credit could provide. Out of this tension emerged a new institutional form. It was not purely public, and it was not entirely private. It combined state authority with financial expertise in a structured partnership. The early central bank represented an attempt to anchor national finance within a permanent organization. Its creation marked a turning point in the architecture of international banking systems. In 1694, the establishment of the Bank of England signaled a decisive shift in financial governance. At the time, England faced heavy war expenses during conflicts with France. The government required immediate funds but lacked sufficient revenue. A group of private investors agreed to lend money to the state in exchange for incorporation and special privileges. By granting this charter, Parliament created an institution empowered to issue banknotes backed by government debt. These notes circulated widely and gradually earned public trust. By the early 18th century, the bank's notes functioned as a reliable substitute for metal coin. The arrangement tied public borrowing directly to a stable source of credit. It also created a template that other nations would later adapt. The mechanism underlying early central banking was straightforward but powerful. The bank purchased government bonds, thereby providing the state with immediate funds. In return, it received the right to issue notes that circulated as money. This works because confidence in government repayment supported confidence in the notes themselves. The reason investors accepted these notes was the expectation of disciplined oversight and limited issuance. Over time, the institution became a guardian of monetary credibility. It regulated the quantity of notes in circulation to preserve convertibility into gold or silver. When pressure mounted, it could adjust lending practices to protect reserves. This blending of public authority and financial discipline established a durable framework for monetary management. The central bank thus became both a lender and a stabilizer within the national economy. By the early 20th century, the central banking model had expanded beyond Europe. In 1913, the creation of the Federal Reserve System reshaped financial governance in the United States. At the time, recurrent banking panics had exposed the weaknesses of a fragmented system. The new structure combined regional reserve banks with a coordinating board. Its mandate included providing liquidity during crises and supervising member institutions. According to contemporary accounts, policymakers sought to balance public oversight with private expertise. The design reflected lessons drawn from European precedents while adapting to American federalism. By 1920, the Federal Reserve played a central role in managing gold reserves and credit conditions. Its actions influenced global capital movements through New York's growing financial prominence. As central banks matured, their responsibilities expanded beyond note issuance and gold management. They became lenders of last resort, offering emergency credit to solvent but illiquid banks. The mechanism relied on swift intervention to prevent panic from spreading through the financial system. This works because confidence can collapse rapidly when depositors fear losses. By providing liquidity against sound collateral, the central bank reassured markets. According to financial studies, timely intervention reduced the frequency of systemic crises. Over time, central banks accumulated expertise in data collection and economic analysis. Their research departments tracked prices, employment, and trade flows to inform policy decisions. These informational capacities strengthened their influence over national economies. The institutional foundations laid in earlier centuries continued to shape the evolution of international banking systems as global integration deepened and new challenges emerged from the interplay of politics, finance, and economic growth. During the 19th century, central banks increasingly defined the boundaries of national financial sovereignty. Industrial expansion intensified the demand for reliable credit, while political unification movements required coherent fiscal systems. Monetary fragmentation posed risks to both trade and taxation. In response, governments consolidated note issuance within singular authorities. These institutions developed standardized procedures for discounting commercial paper and managing reserves. Their growing authority reduced the influence of smaller private banks over currency supply. Stability became associated with centralized oversight rather than dispersed competition. As rail networks linked distant regions, synchronized monetary policy became essential for domestic integration. Central banking foundations therefore evolved alongside the infrastructure of industrial society. By the early 20th century, the central banking model had expanded beyond Europe. In 1913, the creation of the Federal Reserve System reshaped financial governance in the United States. At the time, recurrent banking panics had exposed the weaknesses of a fragmented system. The new structure combined regional reserve banks with a coordinating board. Its mandate included providing liquidity during crises and supervising member institutions. According to contemporary accounts, policymakers sought to balance public oversight with private expertise. The design reflected lessons drawn from European precedents while adapting to American federalism. By 1920, the Federal Reserve played a central role in managing gold reserves and credit conditions. Its actions influenced global capital movements through New York's growing financial prominence. As central banks matured, their responsibilities expanded beyond note issuance and gold management. They became lenders of last resort, offering emergency credit to solvent but illiquid banks. The mechanism relied on swift intervention to prevent panic from spreading through the financial system. This works because confidence can collapse rapidly when depositors fear losses. By providing liquidity against sound collateral, the central bank reassured markets. According to financial studies, timely intervention reduced the frequency of systemic crises. Over time, central banks accumulated expertise in data collection and economic analysis. Their research departments tracked prices, employment, and trade flows to inform policy decisions. These informational capacities strengthened their influence over national economies. The institutional foundations laid in earlier centuries continued to shape the evolution of international banking systems as global integration deepened and new challenges emerged from the interplay of politics, finance, and economic growth. During the 19th century, central banks increasingly defined the boundaries of national financial sovereignty. Industrial expansion intensified the demand for reliable credit, while political unification movements required coherent fiscal systems. Monetary fragmentation posed risks to both trade and taxation. In response, governments consolidated note issuance within singular authorities. These institutions developed standardized procedures for discounting commercial paper and managing reserves. Their growing authority reduced the influence of smaller private banks over currency supply. Stability became associated with centralized oversight rather than dispersed competition. As rail networks linked distant regions, synchronized monetary policy became essential for domestic integration. Central banking foundations therefore evolved alongside the infrastructure of industrial society. In 1800, the establishment of the Banque de France reflected this broader transformation. At the time, France sought financial stabilization after revolutionary upheaval. The new institution received authority to issue notes in Paris, later expanding nationwide. Its governance structure balanced state supervision with shareholder participation. By mid-century, it had become a principal agent of public debt management. The bank maintained convertibility of notes into gold, reinforcing confidence in domestic and foreign markets. During periods of political uncertainty, it coordinated closely with the Treasury to sustain liquidity. Its credibility rested on disciplined reserve practices and predictable lending standards. Through these measures, France integrated its fiscal system into the emerging European monetary order. The mechanism of note standardization altered commercial expectations across borders. When central banks guaranteed convertibility, merchants could calculate exchange values with greater certainty. This works because consistent redemption rules reduce speculation about currency quality. The reason disciplined issuance mattered was that inflationary surges could undermine international contracts. By limiting expansion to the size of gold reserves and reliable assets, central banks reinforced price stability. Their discount windows supplied short-term credit against commercial bills, smoothing seasonal fluctuations. Interest rate adjustments signaled shifts in reserve conditions to global markets. These signals transmitted information rapidly through correspondent banking networks. As a result, domestic monetary decisions carried international implications. Central banking foundations thus became intertwined with cross-border capital flows. In the German states, monetary unification accompanied political consolidation. Following unification in 1871, the Reichsbank assumed responsibility for national currency management. At the time, regional banks still issued diverse notes. The new central authority gradually standardized circulation under the mark. Its statutes required significant gold backing for issued currency. By enforcing these provisions, it strengthened Germany's credit standing in European markets. Industrial expansion in steel and chemicals relied on predictable financing conditions. The bank's discount policy aligned domestic credit with international gold movements. Through disciplined reserve management, it integrated Germany into the wider gold standard system. Political unity and monetary centralization advanced together. The international gold standard operated less as a treaty and more as a shared discipline. Central banks committed to redeem notes in gold at fixed rates. This works because parity anchored exchange rates between participating countries. The mechanism required adjustments when gold reserves shifted due to trade imbalances. A deficit nation would raise interest rates to attract capital inflows. Higher yields encouraged foreign deposits, reversing reserve losses over time. Surplus nations sometimes lowered rates to ease inflows and prevent overheating. These coordinated reactions were not formally negotiated yet followed understood conventions. According to monetary historians, adherence to these practices between 1870 and 1914 produced an era of relative exchange stability. Confidence in central bank resolve underpinned expanding global commerce. Beyond Europe, similar institutional models appeared in rapidly modernizing states. In 1882, the Bank of Japan began consolidating note issuance within a unified authority. At the time, Japan pursued industrial reforms to compete with Western powers. The central bank structure supported fiscal modernization and foreign borrowing. Its statutes emphasized convertibility and prudent reserve management. By aligning its currency with gold, Japan integrated into international capital markets. Foreign investors evaluated its bonds partly through the credibility of its monetary institution. Domestic banks relied on the central authority for rediscount facilities during seasonal strains. Through these channels, central banking principles extended beyond Europe into a global framework. As the 20th century approached, central banks faced mounting pressures from financial crises and geopolitical rivalry. Episodes of panic revealed vulnerabilities within interconnected credit systems. The mechanism of lender of last resort functions gained clearer definition during these shocks. This works because rapid liquidity provision can prevent temporary distress from becoming systemic collapse. Central banks refined collateral standards and emergency procedures in response to experience. According to contemporary analyses, consistent interventions strengthened public trust in monetary authorities. At the same time, excessive support risked encouraging reckless speculation. Balancing discipline with flexibility became a defining institutional challenge. These tensions shaped debates over independence and accountability within national governments. By 1914, central banking foundations were firmly embedded within the architecture of international finance. Gold convertibility linked currencies through shared commitment rather than centralized governance. Communication among monetary authorities remained informal yet influential. The outbreak of global conflict would soon disrupt these arrangements and test institutional resilience. Wartime finance required suspension of gold payments and unprecedented credit expansion. Central banks confronted demands that stretched beyond traditional doctrine. Their earlier development, however, had established administrative capacity and operational coherence. These attributes allowed governments to mobilize resources on an industrial scale. The foundations constructed in the 19th century would endure, even as the pressures of war and reconstruction reshaped their purpose within an increasingly interdependent world economy. The outbreak of the First World War in 1914 marked a decisive rupture in the classical gold standard order. Governments suspended convertibility almost immediately to prevent gold outflows and finance military expenditure. Central banks became instruments of wartime mobilization rather than guardians of parity. Note issuance expanded rapidly as states borrowed on an unprecedented scale. The discipline that had governed interest rate adjustments gave way to fiscal necessity. At the same time, cross-border capital flows contracted sharply under political restrictions. International banking relationships that had relied on predictable exchange rates faced sudden disruption. Central banking foundations were tested under extreme pressure. The institutional habits formed in the 19th century now confronted conditions they had not been designed to manage. By 1918, the financial landscape of Europe had been fundamentally altered. Public debts multiplied several times over pre-war levels. Inflation accelerated in countries that financed deficits through monetary expansion. At the time, policymakers confronted the challenge of reconstruction amid social instability. Attempts to restore the gold standard required painful deflation and fiscal consolidation. In 1925, Britain returned sterling to gold at the pre-war parity under the guidance of the Bank of England. The decision aimed to reassert London's financial leadership. However, the higher exchange rate placed strain on exports and employment. Other countries faced similar tensions between credibility and growth. The interwar settlement revealed the limits of rigid adherence to earlier doctrines. The mechanism of post-war stabilization depended on coordinated monetary restraint. Central banks raised interest rates to defend gold reserves and attract foreign capital. This works because higher returns can offset doubts about fiscal sustainability. The reason adjustment proved difficult was the uneven distribution of gold holdings. The United States and France accumulated large reserves, while others struggled with persistent deficits. Capital flows often responded to speculative expectations rather than trade fundamentals. According to economic studies of the 1920s, fragile banking systems amplified these imbalances. When confidence faltered, withdrawals intensified pressure on central reserves. The framework lacked a formal structure for multilateral support. Central banking foundations operated within a system that demanded cooperation but offered limited mechanisms to secure it. In 1930, an effort to improve coordination led to the creation of the Bank for International Settlements. The institution was established in Basel to facilitate communication among central banks and manage reparations payments. At the time, policymakers recognized the need for a forum dedicated to monetary dialogue. The new organization provided regular meetings and information exchange. It also acted as a trustee and intermediary in certain financial operations. Although its authority was limited, it symbolized acknowledgement of shared responsibility. The presence of a permanent platform for consultation marked a subtle shift toward institutionalized cooperation. Central banking foundations began extending beyond national borders. The challenges of the Great Depression would soon test this emerging framework. The global downturn that began in 1929 exposed structural weaknesses in interwar arrangements. Banking failures cascaded across continents as credit contracted sharply. The mechanism of lender of last resort intervention was unevenly applied. This works because decisive liquidity provision can stabilize expectations, yet hesitation can deepen panic. Some central banks defended gold reserves by tightening policy even as domestic banks collapsed. The reason for this choice lay in the priority given to exchange stability over employment. According to historical analyses, countries that abandoned gold earlier recovered more quickly. By 1933, several major economies had suspended convertibility once again. Monetary nationalism replaced the aspiration of universal parity. Central banking doctrine evolved under the weight of economic depression and political upheaval. The lessons of the interwar period shaped a new approach during the Second World War. Governments again required vast financial resources, yet policymakers sought to avoid the disorder that followed the previous conflict. In 1944, representatives from 44 nations convened in New Hampshire to design a post-war monetary system. The resulting agreement established the International Monetary Fund and the World Bank. These institutions aimed to promote exchange stability and support reconstruction. Fixed but adjustable exchange rates replaced the rigid gold standard model. Central banks committed to maintain parities within defined bands, while access to multilateral financing reduced the burden of unilateral adjustment. The framework embedded national monetary authorities within a cooperative structure. The mechanism of the Bretton Woods system combined discipline with flexibility. Currencies were pegged to the United States dollar, which remained convertible into gold for official holders. This works because a central anchor can simplify exchange calculations and encourage trade. The reason for allowing adjustments under defined conditions was to accommodate persistent imbalances. Central banks intervened in foreign exchange markets to maintain their pegs. When pressures intensified, governments could negotiate realignments rather than endure prolonged deflation. According to post-war economic data, this arrangement supported rapid growth and expanding international commerce. Capital controls limited destabilizing short-term flows. Central banking foundations thus entered a period of structured multilateralism. By the early 1970s, strains re-emerged as global capital mobility increased and confidence in dollar convertibility weakened. In 1971, the United States suspended gold convertibility, effectively ending the Bretton Woods system. Exchange rates among major currencies gradually shifted toward floating regimes. Central banks adapted by focusing more directly on domestic price stability and financial supervision. The institutional legacy of earlier centuries, however, remained visible. Cooperation through the Bank for International Settlements and other forums continued to shape policy dialogue. Monetary authorities accumulated greater analytical capacity and transparency over time. The foundations established through war, crisis, and reform provided a durable platform for modern central banking. As financial globalization deepened in the late 20th century, these institutions stood at the center of an increasingly complex network of markets, obligations, and shared responsibilities that would continue to evolve. The devastation of the Second World War left much of Europe and Asia economically shattered and financially dislocated. Industrial capacity had been destroyed, trade routes disrupted, and currencies destabilized by years of military spending and inflation. Banking systems that once facilitated cross-border commerce were weakened by defaults, capital controls, and political fragmentation. Governments recognized that the interwar period had demonstrated the dangers of competitive devaluations and uncoordinated monetary policies. The mechanism of collapse during the 1930s had shown how fragile international settlements could be when confidence eroded. Policymakers concluded that reconstruction required a stable framework for exchange rates and capital flows. This works because trade and investment depend on predictable currency relationships and credible institutions. In 1944, representatives from 44 nations gathered in New Hampshire to design a new architecture for global finance. The conference at Bretton Woods marked a deliberate attempt to construct rules that would prevent another cycle of depression and conflict. By 1944, Allied planners were already drafting proposals for post-war monetary cooperation. At the time, the United States held the majority of the world's gold reserves and possessed unmatched industrial strength. Britain, though financially strained, contributed intellectual leadership through the ideas of John Maynard Keynes. The negotiations balanced American preferences for stability with British concerns about adjustment burdens. According to official conference records, the delegates sought a system that combined fixed exchange rates with limited flexibility. Studies show that interwar volatility had reduced trade volumes and amplified political tensions. The agreement established the International Monetary Fund and the International Bank for Reconstruction and Development. Each institution reflected a distinct function within the broader system. The fund would oversee exchange rate stability and provide short-term balance of payment support. The bank would finance reconstruction and long-term development. The core of the Bretton Woods framework rested on a gold exchange standard anchored by the United States dollar. Member countries committed to maintain fixed exchange rates against the dollar within narrow bands. The United States in turn promised to convert dollars held by foreign central banks into gold at a fixed price of $35 per ounce. The mechanism relied on confidence in American reserves and fiscal discipline. When a country faced a temporary balance of payments deficit, it could borrow from the International Monetary Fund rather than devalue immediately. This works because short-term financing smooths adjustments and prevents panic-driven currency movements. Persistent imbalances, however, required policy changes or formal realignments approved by the fund. Capital controls were permitted to give governments autonomy over domestic objectives. The design reflected a compromise between stability and national sovereignty. Reconstruction in Europe required more than exchange rate coordination and short-term liquidity. Industrial economies needed capital to rebuild infrastructure, modernize factories, and restore transportation networks. In 1947, the United States launched the European Recovery Program, commonly known as the Marshall Plan. At the time, European currencies were not fully convertible and trade remained constrained by shortages of dollars. The influx of American aid provided both financial resources and confidence in recovery. According to economic historians, the program transferred over $13 billion between 1948 and 1951. Studies show that beyond the direct funds, the plan encouraged policy coordination and trade liberalization among recipient countries. Institutions such as the Organization for European Economic Cooperation emerged to administer cooperation. Banking systems gradually stabilized as growth resumed and inflation moderated. The post-war order also reshaped central banking practices within participating countries. Governments accepted that monetary policy should support domestic employment while maintaining external balance. The mechanism required coordination between finance ministries and central banks under the surveillance of the International Monetary Fund. Exchange rate commitments constrained excessive money creation, yet capital controls preserved room for social welfare expansion. This works because restricted cross-border capital flows limited speculative attacks on currencies. Domestic banks operated within regulated environments that emphasized stability over innovation. Interest rates were often guided by policy objectives rather than purely market forces. The result was a period of relatively low financial volatility compared with the interwar years. International lending expanded cautiously through official channels and established commercial relationships. Confidence in the dollar as a reserve currency deepened as trade volumes increased. By the mid-1950s, Western Europe had largely restored industrial production to pre-war levels. At the time, currency convertibility remained partial, but progress toward liberalization accelerated. In 1958, major European economies declared external convertibility for current account transactions. The step signaled renewed confidence in exchange rate stability and monetary cooperation. According to International Monetary Fund data, global trade grew at unprecedented rates during the following decade. Studies show that fixed exchange rates reduced uncertainty for exporters and investors. The United States continued to supply dollars through overseas spending and private investment. These dollar outflows financed global liquidity and supported expansion. However, they also created growing claims on American gold reserves. The structural tension embedded in the system began to surface gradually. The reason this tension emerged lay in the asymmetry of responsibilities within the gold exchange standard. The United States could finance deficits by issuing dollars that other countries held as reserves. Other nations, however, were required to adjust domestic policies when facing external imbalances. This works because reserve currency status grants unique flexibility to the issuing country. Over time, the accumulation of dollars abroad exceeded the gold stock available for conversion. Confidence remained strong during the 1950s, yet doubts slowly increased among foreign central banks. The mechanism of potential instability became known as the Triffin dilemma. It described the conflict between providing global liquidity and maintaining gold convertibility. As trade and investment expanded, the demand for dollars rose faster than American gold holdings. The system depended increasingly on trust rather than metal. Through the 1960s, policymakers attempted incremental reforms to preserve the post-war financial order. Cooperative arrangements such as gold pools and currency swap lines were introduced to manage pressures. Central banks coordinated interventions to maintain fixed exchange rates within agreed bands. The structure still reflected the principles established at Bretton Woods, emphasizing stability and multilateral oversight. Yet underlying imbalances signaled that the architecture faced mounting strain. The growth of offshore dollar markets added complexity beyond the original design. Financial innovation gradually eroded the effectiveness of capital controls. The post-war settlement had delivered decades of expansion and reconstruction. Its durability, however, depended on conditions that were beginning to shift in subtle but consequential ways. As the 1960s progressed, pressures within the Bretton Woods system intensified beneath the surface of apparent stability. The expansion of global trade required an ever-growing supply of dollar reserves to finance settlements and maintain exchange rate pegs. American fiscal policy became increasingly expansionary as domestic programs and overseas military commitments expanded simultaneously. The mechanism of imbalance operated quietly through persistent United States balance of payments deficits. Dollars flowed outward to foreign central banks, accumulating in official reserves across Europe and Japan. This works because the reserve currency country provides liquidity by running deficits that others accept as assets. Confidence remained intact as long as foreign governments believed in the credibility of gold convertibility. However, the ratio of outstanding dollars to American gold reserves continued to widen year after year. The structural contradiction between global liquidity needs and finite gold holdings became more difficult to ignore. By 1961, leading central banks formed the London Gold Pool to stabilize the official gold price. At the time, speculative demand threatened to push the market price above the $35 parity. The arrangement required coordinated sales of gold to maintain confidence in convertibility. According to archival records, the United States supplied a significant share of these interventions. Studies show that cooperation temporarily reduced volatility in bullion markets. Yet underlying dollar liabilities kept expanding as international banking activity accelerated. European commercial banks increasingly held and traded dollars outside the United States in what became known as the eurodollar market. The offshore environment operated beyond the full reach of domestic American regulation. This development added flexibility to global finance while complicating official oversight. Monetary authorities found themselves defending a system that private markets were gradually outgrowing. The eurodollar market altered the mechanics of international banking in subtle but consequential ways. Banks in London and other financial centers accepted dollar deposits and extended dollar loans without direct reliance on American reserves. The mechanism created a parallel pool of liquidity that expanded independently of gold constraints. This works because offshore deposits represented claims on banks rather than immediate claims on the United States Treasury. As multinational corporations grew, they relied on these markets to finance trade and investment across continents. Capital controls that had once insulated domestic economies became less effective against innovative financial instruments. The distinction between national and international banking blurred as balance sheets stretched across jurisdictions. Official institutions retained formal authority over exchange rates, yet private actors increasingly shaped liquidity conditions. The architecture of Bretton Woods faced pressures from within its own success. By the late 1960s, inflationary pressures intensified in the United States. At the time, fiscal spending related to the Vietnam War and social programs expanded the domestic money supply. Foreign central banks accumulated additional dollars as trade imbalances persisted. According to data from the International Monetary Fund, global reserves became increasingly dollar-heavy. Studies show that some European governments began quietly converting surplus dollars into gold. The London gold pool collapsed in 1968 under sustained speculative demand. A two-tier gold market emerged, separating official transactions from private trading. Confidence in the fixed gold price weakened as market prices fluctuated freely. The symbolic anchor of the system appeared less secure. The reason convertibility became untenable lay in the arithmetic of reserve accumulation. Outstanding foreign-held dollars exceeded the gold stock available at the official price. This works because simultaneous conversion requests could exhaust reserves rapidly. Policymakers faced a dilemma between tightening domestic policy to defend gold or allowing greater flexibility in exchange arrangements. Attempts at incremental reform included the creation of special drawing rights in 1969. These reserve assets were designed to supplement gold and dollars within the system. The mechanism provided limited additional liquidity but did not resolve confidence concerns. Financial markets interpreted the reforms as temporary measures rather than structural solutions. Exchange rate realignments occurred sporadically as countries adjusted parities. The cumulative strain signaled that foundational change was approaching. In August 1971, the United States suspended the convertibility of dollars into gold. At the time, President Richard Nixon framed the decision as a temporary measure to protect the dollar. According to official statements, the action sought to address speculative attacks and restore balance. Studies show that foreign governments had increased conversion demands in the preceding months. The suspension effectively ended the central pillar of the Bretton Woods arrangement. Exchange rates were briefly renegotiated under the Smithsonian Agreement later that year. However, fixed parities proved difficult to maintain amid divergent economic conditions. Currency markets experienced heightened volatility as confidence in pegged rates eroded. The era of a gold-anchored dollar standard concluded with administrative finality. The transition from fixed to more flexible exchange rates unfolded unevenly across countries. Some governments attempted managed floats within narrow bands to preserve stability. The mechanism of floating rates allowed market forces to determine currency values relative to supply and demand. This works because exchange rates adjust automatically to reflect trade balances and capital flows. Central banks retain the capacity to intervene when movements appeared disorderly. Commercial banks adapted quickly to the new environment by expanding foreign exchange trading operations. Derivative instruments developed to hedge currency risk in increasingly liberalized markets. International banking became more market-driven and less anchored to official parity commitments. The post-war order shifted from rule-bound rigidity toward negotiated flexibility. By the mid-1970s, the contours of a new financial landscape were visible. At the time, oil price shocks and global inflation further complicated monetary management. According to economic research, floating exchange rates absorbed some external shocks while introducing new uncertainties. Studies show that cross-border capital flows expanded rapidly as controls were gradually dismantled. Banks operated in a more competitive and interconnected system than the architects of 1944 had envisioned. The discipline of gold convertibility had been replaced by credibility based on policy coordination and market confidence. International institutions continued to provide surveillance and financial assistance. Yet the balance of influence tilted toward private capital markets and multinational banking networks. The foundations laid after the war had given way to a more fluid and dynamic era of global finance. The collapse of the gold convertibility commitment did not dismantle international finance, but it transformed its organizing principles. Exchange rates among major economies began to float more freely after 1973, ending the era of formally fixed parities. Governments retained central banks and international institutions, yet market forces gained greater influence over currency valuation. The mechanism of adjustment shifted from official reserve movements to continuous price discovery in foreign exchange markets. This works because floating rates absorb trade imbalances through currency depreciation or appreciation rather than through gold flows. Commercial banks expanded their dealing rooms to manage increased volatility and client demand. Cross-border lending accelerated as restrictions on capital movements were gradually relaxed. The dollar remained central to global transactions despite the end of gold backing. Confidence now rested on the size and productivity of the American economy rather than on a metal standard. By the mid-1970s, new sources of capital reshaped global banking patterns. At the time, oil-exporting countries accumulated large surpluses following sharp increases in petroleum prices. According to data from the Bank for International Settlements, these funds were deposited primarily in major international banks. Studies show that commercial banks recycled so-called petrodollars into loans for developing economies. The mechanism involved accepting large deposits from surplus nations and extending syndicated credits to deficit countries. This works because banks intermediate between capital-rich and capital-poor regions seeking returns and growth. Latin American and other emerging market borrowers gained access to unprecedented levels of external finance. The scale of international lending far exceeded earlier official development programs. Private banking networks became central conduits for global liquidity redistribution. The rapid growth of cross-border lending introduced new vulnerabilities into the financial system. Many borrowing countries assumed that export revenues would continue rising steadily. The mechanism of risk accumulation operated through variable interest rates and short-term funding structures. This works because loans priced to floating benchmarks can become more expensive when global rates increase. During the late 1970s, inflation in advanced economies prompted central banks to tighten monetary policy sharply. Higher interest rates raised debt servicing costs for heavily indebted nations. According to international financial statistics, several countries struggled to meet obligations by the early 1980s. The interconnected balance sheets of major banks transmitted stress across continents. What had begun as a recycling of surplus funds evolved into a sovereign debt crisis. By 1982, Mexico announced that it could no longer service its external debt obligations. At the time, global banking leaders and policymakers feared a cascade of defaults. According to historical accounts, emergency negotiations were organized under the coordination of the International Monetary Fund and major creditor banks. Studies show that restructuring agreements extended maturities and imposed policy conditions on borrowers. The mechanism of crisis management relied on collective action to prevent sudden withdrawal of credit. This works because coordinated rescheduling can stabilize expectations and avoid systemic collapse. Commercial banks accepted temporary constraints in exchange for gradual repayment frameworks. International institutions expanded their role in surveillance and conditional lending. The episode underscored how private banking had become deeply entwined with sovereign risk. The 1980s also witnessed financial deregulation in several advanced economies. Governments reduced interest rate controls and lifted barriers between different categories of financial institutions. The mechanism of liberalization encouraged competition and innovation within domestic banking systems. This works because fewer regulatory constraints allow institutions to respond more flexibly to market signals. New financial instruments such as interest rate swaps and currency futures expanded rapidly. Banks developed sophisticated risk management practices to navigate fluctuating exchange and interest rates. Capital markets grew alongside traditional bank lending as corporations sought diversified funding sources. The structure of international finance became increasingly complex and integrated. Regulatory authorities faced the challenge of supervising institutions operating across multiple jurisdictions. By the late 1980s, policymakers recognized the need for common prudential standards. At the time, differences in capital requirements created uneven competitive conditions among banks. According to agreements reached in Basel in 1988, an international framework for minimum capital ratios was established. Studies show that the Basel Accord aimed to strengthen bank resilience against credit losses. The mechanism required institutions to hold capital proportional to the riskiness of their assets. This works because higher capital buffers absorb shocks and reduce insolvency probability. Supervisory cooperation expanded through regular meetings and information sharing. The accord represented a new form of coordination distinct from exchange rate management. Attention shifted from currency parities toward institutional soundness within global banking networks. The transformation of the post-war order thus extended beyond monetary arrangements to encompass regulatory cooperation. Floating exchange rates and liberalized capital flows demanded new tools to manage systemic risk. The mechanism of oversight increasingly relied on transparency, disclosure, and stress testing. This works because informed markets and vigilant supervisors can identify imbalances before they escalate. International institutions adapted their mandates to monitor capital movements and financial stability indicators. Commercial banks continued expanding geographically through mergers and acquisitions. Technological advances accelerated transaction processing and cross-border communication. The global financial system entered an era defined by speed and scale rather than by fixed anchors. Stability depended on policy credibility and institutional coordination rather than on metallic reserves. As the 20th century approached its final decade, the foundations of contemporary international banking were firmly established. Markets determined exchange rates, private capital flowed across borders with relative freedom, and regulatory bodies sought to harmonize standards. The legacy of Bretton Woods persisted in institutions that provided forums for dialogue and crisis response. Yet the operating logic of the system had evolved toward flexibility and market discipline. The mechanism of global finance now revolved around continuous interaction between states and private actors. This works because complex economies require adaptable frameworks capable of absorbing shocks. Episodes of instability continued to test resilience, prompting further reforms and innovation. International banking had moved far from the gold-anchored commitments of the 1940s. The architecture remained dynamic, shaped by lessons drawn from decades of expansion, crisis, and institutional adaptation, and it continued to evolve as new economic forces gathered strength. By the late 20th century, international banking had entered a new phase defined by integration rather than simple cross-border exchange. Institutions that once maintained representative offices abroad began transforming themselves into fully operational multinational networks. Capital moved with increasing speed across continents, enabled by deregulation, technological innovation, and expanding trade relationships. The boundaries that had once separated domestic finance from international activity became progressively blurred. Banks headquartered in New York, London, Tokyo, and Frankfurt developed strategies that treated the world as a single operating landscape. This shift did not occur abruptly, but through layered reforms and competitive pressures that accumulated over decades. By the 1980s, financial executives were no longer thinking primarily in national terms, but in terms of global market share and cross-border balance sheets. The architecture of international banking was being reassembled into a tightly connected system whose components influenced one another continuously. The mechanism driving this globalization rested on the liberalization of capital accounts and the removal of structural barriers. Governments reduced restrictions on foreign ownership, interest rate controls, and currency convertibility. The reason policymakers pursued these reforms was rooted in a belief that open financial markets would allocate capital more efficiently. This works because capital tends to flow toward jurisdictions offering higher returns adjusted for risk. When barriers fall, banks gain the ability to deploy funds where profitability is greatest rather than where regulation confines them. Competitive pressures intensify under these conditions, pushing institutions to innovate and expand abroad. Domestic markets alone often could not provide sufficient growth for large banks with expanding balance sheets. As a result, international lending, foreign direct investment financing, and offshore operations became central components of strategic planning. The internal culture of banking shifted toward global risk assessment and currency management as routine functions rather than specialized activities. Historical precedents for this transformation can be traced to earlier periods of cross-border finance, yet the scale after 1970 was unprecedented. By 1971, the collapse of the Bretton Woods system ended fixed exchange rate arrangements that had governed post-war finance. At the time, the shift toward floating currencies introduced new forms of volatility and opportunity. Banks expanded foreign exchange trading desks to manage risks associated with fluctuating rates. By the late 1970s, petrodollar recycling linked oil exporting nations with borrowing countries through complex syndicated loans. According to data compiled by the Bank for International Settlements, cross-border bank claims grew rapidly during this decade. Studies show that international lending volumes multiplied several times between 1975 and 1982. These developments created dense interbank connections that spanned Europe, North America, Asia, and emerging markets. The globalization of banking was becoming measurable in statistical aggregates as well as institutional presence. In Europe, regulatory harmonization accelerated integration within the continent while connecting it more deeply to global markets. The creation of the single market framework reduced legal fragmentation among member states. Banks headquartered in Paris, Milan, and Madrid gained passporting rights that allowed them to operate across borders with fewer administrative obstacles. The mechanism behind this integration was mutual recognition of regulatory standards. This works because a shared rulebook lowers compliance uncertainty and encourages capital mobility. Institutions could consolidate operations and allocate capital across branches without navigating entirely separate legal regimes. The reason this mattered globally was that European banks were among the largest in the world by asset size. Their expansion into Latin America, Eastern Europe, and Asia transmitted European financial practices outward. Cross-border mergers and acquisitions became common strategies for achieving scale and diversification. Technological change reinforced these structural reforms by compressing time and distance. Electronic payment systems replaced slower correspondent networks that had once required manual reconciliation. Real-time gross settlement platforms enabled high-value transfers to clear within seconds. The mechanism was straightforward. Digitization reduced transaction costs and operational risk. This works because automated systems limit human error and allow continuous monitoring of positions across jurisdictions. Global trading floors could coordinate activities around the clock, passing responsibility from one time zone to another. Risk management models integrated data from multiple subsidiaries into centralized dashboards. According to industry analyses from the 1990s, information technology expenditures became one of the largest components of bank investment budgets. Studies show that institutions adopting advanced systems achieved greater efficiency and could manage larger international portfolios. The physical expansion of banking was increasingly accompanied by invisible digital infrastructure. By the 1990s, emerging markets were deeply entwined with global banking networks. At the time, many countries in Asia and Latin America liberalized financial sectors to attract foreign capital. International banks established subsidiaries and joint ventures to participate in local credit growth. According to reports from the International Monetary Fund, capital inflows to developing economies surged during this period. Studies show that foreign bank presence often increased competition and introduced new financial products. Yet the same interconnectedness also transmitted instability. By 1997, currency crises in Thailand and Indonesia reverberated through balance sheets in London and New York. At the time, exposures that had seemed diversified revealed common vulnerabilities linked to exchange rate mismatches. The globalization of banking had created channels through which shocks could travel rapidly and unexpectedly. The integration of banking systems reshaped the internal governance of institutions as well. Executive decision-making became centralized even as operations dispersed geographically. The mechanism behind this concentration was the need for unified risk oversight across currencies and jurisdictions. This works because consolidated supervision allows management to identify correlations that local managers might overlook. Capital adequacy standards such as those developed under the Basel framework encouraged consistent measurement of credit and market risk. The reason these standards gained global acceptance was that large banks operated in multiple countries and required comparable benchmarks. According to the Bank for International Settlements, internationally active banks increasingly reported using standardized models for evaluating exposures. This harmonization supported expansion while attempting to contain systemic fragility. Yet as balance sheets grew more complex and cross-border claims deepened, the system moved toward a condition in which stability depended on confidence that could shift abruptly under pressure. As global banking networks expanded, competitive dynamics shifted from national rivalry to transnational consolidation. Large institutions sought scale not only for prestige but for balance sheet resilience and diversified revenue streams. Cross-border mergers became a primary instrument for achieving this scale. Banks acquired foreign retail networks, investment banking boutiques, and asset management firms to broaden their reach. The mechanism behind consolidation was rooted in economies of scale and scope. This works because larger institutions can spread fixed regulatory and technological costs across wider asset bases. The reason consolidation accelerated in the 1990s and early 2000s was that deregulation removed many barriers to ownership. Strategic planners calculated that a broader geographic footprint reduced dependence on any single economy. At the same time, integration increased managerial complexity and demanded more sophisticated governance structures. Executive committees began to resemble multinational councils coordinating capital flows across dozens of jurisdictions. The growth of international syndicated lending further deepened interconnectedness among financial centers. Large infrastructure projects, sovereign borrowing programs, and corporate expansions required funding that exceeded the capacity of individual banks. Syndicates distributed risk among multiple institutions across continents. The mechanism was collective underwriting followed by structured allocation of loan shares. This works because risk diversification lowers the exposure borne by any single lender. Participating banks shared information, documentation standards, and pricing frameworks. According to data published by the Organization for Economic Cooperation and Development, syndicated lending volumes rose sharply during periods of economic optimism. Studies show that such lending strengthened ties between advanced financial centers and emerging markets. Yet when economic conditions deteriorated, syndicated structures transmitted distress simultaneously to numerous balance sheets. Coordination that once supported growth could amplify contraction when confidence faltered. Technological platforms transformed wholesale banking into a continuous global operation. Trading systems linked desks in Hong Kong, London, and New York into near seamless cycles. Currency markets operated 24 hours a day, reinforcing the perception of a single financial arena. The mechanism underlying this continuity was digital connectivity combined with standardized messaging protocols. This works because uniform communication formats reduce settlement errors and processing delays. Derivatives markets expanded as risk management tools became embedded in daily operations. Banks engineered interest rate swaps, currency swaps, and credit derivatives to hedge exposures arising from international activities. According to research from major central banks, derivatives outstanding grew exponentially during the early 21st century. Studies show that sophisticated instruments improved the ability to distribute risk across global counterparties. At the same time, the opacity of some structures complicated oversight and blurred lines of accountability. Regulatory cooperation evolved alongside market expansion, reflecting recognition that purely national supervision was insufficient. International committees convened to harmonize capital standards and disclosure requirements. The Basel Accords provided common definitions for risk-weighted assets and minimum capital ratios. The mechanism was negotiated agreement followed by domestic implementation. This works because shared standards reduce regulatory arbitrage and promote comparability. Supervisors exchanged information about cross-border exposures and systemic vulnerabilities. The reason cooperation intensified was that crises in one jurisdiction increasingly affected others through interconnected banks. According to official communiques from multilateral forums, authorities acknowledged the necessity of coordinated stress testing. Studies show that jurisdictions adopting harmonized standards experienced greater transparency in reporting. Nevertheless, differences in enforcement and political priorities persisted beneath the appearance of uniformity. The expansion of global banking also reshaped retail finance in many regions. Foreign banks introduced credit cards, mortgage products, and consumer lending models adapted from mature markets. Local customers gained access to new forms of credit and savings instruments. The mechanism was knowledge transfer combined with capital infusion. This works because multinational institutions deploy tested product designs into new environments. Competitive pressure often compelled domestic banks to modernize operations and improve customer service. According to surveys conducted by development institutions, foreign bank entry sometimes enhanced financial inclusion in urban centers. Studies show that technology-driven platforms reduce transaction costs for remittances and small business lending. Yet disparities remained between metropolitan regions and rural areas where profitability was uncertain. Global integration delivered benefits unevenly, shaped by demographic and institutional factors. Financial globalization altered the behavior of central banks and monetary authorities. Exchange rate management became more complex in an environment of rapid capital mobility. The mechanism was heightened sensitivity to investor sentiment and cross-border flows. This works because even modest portfolio reallocations can influence domestic liquidity conditions. Policymakers accumulated foreign exchange reserves as buffers against sudden reversals. According to International Monetary Fund statistics, reserve holdings expanded significantly after episodes of crisis. Studies show that precautionary accumulation aimed to reassure markets and stabilize currencies. Central banks also engaged in currency swap arrangements to provide liquidity during stress. These arrangements illustrated recognition that financial stability had become a shared responsibility. The architecture of globalization required monetary authorities to operate within a densely connected framework. By the early 21st century, the scale of international banking activity was visible in consolidated balance sheets. Cross-border assets constituted substantial portions of major banks' total holdings. At the time, executives evaluated performance through global metrics rather than domestic benchmarks. Shareholders demanded returns that reflected international diversification strategies. According to financial disclosures, revenue streams from emerging markets accounted for growing shares of profits at leading institutions. Studies show that globalization altered risk correlations, sometimes reducing volatility during expansionary periods. However, interconnected exposures also meant that localized downturns could cascade through multinational groups. The pursuit of efficiency and growth had produced institutions whose stability depended on synchronized economic conditions. When optimism prevailed, integration appeared to validate itself through rising asset values and expanding credit. When uncertainty emerged, the same channels that facilitated growth could transmit strain with remarkable speed, reinforcing the reality that global banking operated within a single, fragile ecosystem shaped by confidence and liquidity conditions that were constantly evolving. The global financial crisis of 2008 exposed the structural tensions embedded within decades of banking globalization. Institutions that had expanded across continents discovered that diversification did not eliminate correlated risk. Mortgage-backed securities originating in the United States appeared on balance sheets in Europe and Asia. The mechanism of contagion operated through interbank lending markets and complex derivatives contracts. This works because interconnected counterparties depend on mutual confidence to maintain short-term funding. When doubts emerged about asset quality, liquidity evaporated with surprising speed. Funding pressures in one jurisdiction transmitted instantly to others through wholesale markets. According to reports from the Financial Stability Board, cross-border exposures amplified the initial shock. Studies show that internationally active banks experienced simultaneous stress across multiple subsidiaries. The crisis revealed that global integration required equally global mechanisms of oversight and crisis management. Governments responded with coordinated interventions designed to stabilize the international system. Central banks provided emergency liquidity through expanded lending facilities and currency swap lines. The mechanism was collective action aimed at restoring confidence in core institutions. This works because credible backstops reduce panic-driven withdrawals and funding freezes. Fiscal authorities injected capital into systemically important banks to prevent disorderly failures. According to official data released in the aftermath, rescue packages reached unprecedented scale. Studies show that cooperation among major economies limited the depth of contraction compared to earlier uncoordinated crises. Regulatory reforms followed, emphasizing higher capital buffers and more rigorous stress testing. Supervisors scrutinized cross-border structures that had obscured risk concentrations. The episode marked a turning point in the perception of globalization as an unqualified source of efficiency. In the years after the crisis, international banking entered a phase of recalibration rather than retreat. Institutions reassessed foreign operations and sometimes reduced presence in markets deemed peripheral. The mechanism behind this retrenchment was capital constraint combined with shareholder pressure for stability. This works because stricter capital requirements raise the cost of maintaining far-flung subsidiaries. Some banks sold assets in emerging economies to focus on core regions. According to analyses from multilateral institutions, cross-border lending growth slowed during the early 2010s. Studies show that regional banking groups gained relative prominence as global giants streamlined operations. Yet globalization did not reverse entirely, as trade flows and investment linkages continued to demand financial intermediation. Digital communication and payment technologies preserved the capacity for rapid cross-border transactions. The system adapted, balancing ambition with caution shaped by recent memory. The rise of financial technology introduced a new dimension to global banking integration. Payment platforms, online lending marketplaces, and digital wallets operated across borders with limited physical infrastructure. The mechanism was software-driven intermediation that reduced reliance on traditional branch networks. This works because digital platforms scale quickly without proportional increases in fixed cost. Established banks partnered with technology firms to modernize services and reach new customers. According to industry surveys, investment in fintech collaborations accelerated during the mid-2010s. Studies show that mobile banking expanded access in regions previously underserved by conventional institutions. At the same time, cybersecurity risks became central to strategic planning. Cross-border data flows created vulnerabilities that required international coordination. The digital layer of globalization added speed and complexity to an already interconnected system. Geopolitical developments also began to influence patterns of banking globalization. Trade disputes and shifting alliances altered expectations about regulatory alignment. The mechanism was policy uncertainty affecting cross-border investment decisions. This works because banks evaluate long-term commitments based on predictable legal frameworks. Sanctions regimes and compliance requirements increased operational costs for multinational institutions. According to public filings, banks devoted substantial resources to monitoring transactions for adherence to international rules. Studies show that geopolitical risk became an explicit variable in credit assessment models. Some countries promoted domestic payment systems to reduce dependence on external networks. These adjustments reflected awareness that financial integration carried strategic implications beyond economics. Global banking operated within a landscape shaped by both market forces and sovereign priorities. Emerging markets continued to play a significant role in shaping the direction of globalization. Rapid urbanization and rising incomes generated demand for credit and investment services. The mechanism of growth relied on demographic expansion and infrastructure development. This works because financial intermediation channels savings into productive projects. International banks competed with local champions to finance transportation, energy, and telecommunications networks. According to development bank reports, blended finance structures combined public and private capital across borders. Studies show that diversified funding sources improved resilience in certain sectors. However, currency volatility and political transitions introduced persistent uncertainty. Institutions learned to integrate macroeconomic analysis with local expertise. The interaction between global capital and domestic conditions remained dynamic and sometimes unpredictable. Environmental considerations gradually entered the strategic calculations of global banks. Climate-related risks affected asset valuations and long-term profitability. The mechanism was recognition that physical and transition risks influence credit quality. This works because lending to carbon-intensive industries carries exposure to regulatory change and market shifts. International frameworks encourage disclosure of climate-related financial information. According to sustainability reports, major banks committed to reducing financed emissions over time. Studies show that green bond markets expanded rapidly as investors sought environmentally aligned assets. Cross-border collaboration supported standardized definitions and reporting practices. Financing renewable energy projects became a prominent component of international portfolios. The evolution of globalization increasingly incorporated environmental responsibility alongside traditional metrics of return. By the mid-21st century, international banking had evolved into a layered system combining physical presence, digital infrastructure, regulatory coordination, and geopolitical awareness. Integration remained a defining characteristic, yet it coexisted with safeguards shaped by crisis experience. The mechanism sustaining this balance was continuous negotiation between efficiency and stability. This works because markets reward innovation while societies demand resilience. According to longitudinal analyses from academic institutions, cross-border claims fluctuated with economic cycles but retained structural significance. Studies show that multinational banks adapted organizational models to accommodate both global reach and local accountability. The architecture of globalization thus became more intricate rather than simpler. Interdependence persisted as a central feature of modern finance. Beneath the visible flows of capital and credit, relationships of trust and regulation formed the foundation upon which the next phase of international banking would gradually unfold. International banking expanded rapidly in the late 19th and early 20th centuries, linking financial centers across continents through correspondent relationships and telegraphic communication. As capital moved more freely across borders, risks also became more interconnected. A banking panic in one city could transmit distress to distant markets within days. The earlier chapters traced the growth of clearing systems, central banks, and multinational lending. By the early 20th century, those structures required formal oversight that extended beyond local jurisdictions. Governments began to recognize that private balance sheets carried public consequences. The failure of a major bank could destabilize trade, employment, and currency values. This realization laid the foundation for modern regulatory frameworks designed to monitor, constrain, and sometimes rescue international institutions. Oversight became an essential companion to expansion. The mechanism of regulation developed in response to recurring crises that exposed weaknesses in supervision. The reason oversight gained urgency was that banks operated with leverage, transforming short-term deposits into long-term loans. This structure created maturity mismatches that could unravel quickly under pressure. When depositors lost confidence, liquidity evaporated and asset sales accelerated losses. The mechanism of regulatory capital requirements sought to cushion these shocks by obligating banks to hold reserves against potential losses. This works because a thicker capital base absorbs declines in asset values before creditors are affected. Supervisory examinations added another layer, reviewing loan quality and governance practices. Reporting standards required transparent accounting so that regulators could identify vulnerabilities early. Over time, regulation became a structured system of rules, inspections, and enforcement. By 1930, the fragility of international banking had become undeniable. The collapse of Austria's largest bank, Kreditanstalt, triggered a cascade of financial distress across Central Europe. At the time, cross-border lending tied German and British institutions closely to Viennese balance sheets. Withdrawals intensified, and foreign creditors demanded repayment in gold or hard currency. By 1931, several German banks suspended operations as confidence deteriorated. Governments imposed capital controls to prevent further outflows. The gold standard constrained policy responses, limiting central banks' ability to expand liquidity. These events demonstrated how interconnected banks amplified systemic risk. The crisis reshaped attitudes towards supervision and cooperation. In response to these failures, policymakers sought mechanisms for international dialogue among central banks. In 1930, the Bank for International Settlements was established in Basel to facilitate cooperation and manage reparations payments. At the time, its role was limited, but it created a permanent forum for communication among monetary authorities. According to historical records, the institution gradually evolved into a platform for discussing regulatory standards. After the disruptions of the Second World War, central banks renewed their engagement through this forum. Studies show that consistent communication reduced misunderstandings during periods of stress. Over decades, committees formed under its umbrella to coordinate supervisory practices. This quiet institutional development laid groundwork for later global agreements. The mechanism of coordinated regulation became more pronounced after the breakdown of the Bretton Woods system in the early 1970s. The reason coordination intensified was that floating exchange rates increased volatility in international lending. Banks expanded into new markets, including syndicated loans to developing economies. This works because diversified portfolios promised higher returns, yet they also concealed correlated risks. When oil price shocks and recessions struck in the 1970s, many borrowing countries struggled to service debts. Supervisors recognized that unilateral national rules were insufficient for multinational banks. Committees within the Basel framework drafted common standards to align capital adequacy calculations. Shared definitions reduced opportunities for regulatory arbitrage. International banking supervision entered a new phase of formal harmonization. By 1988, a landmark agreement known as Basel I introduced minimum capital requirements for internationally active banks. At the time, the accord assigned risk weights to different asset categories, from sovereign debt to commercial loans. The framework required banks to maintain capital equal to at least 8% of risk-weighted assets. According to central bank publications, the objective was to strengthen stability while preserving competitive equality. By 1996, amendments incorporated market risk into the calculation, reflecting the growth of trading activities. Supervisory authorities in major economies adopted the standards into domestic law. Compliance became a prerequisite for operating in global markets. Basel I represented the first comprehensive attempt to codify international banking oversight. The mechanism of oversight expanded further with the introduction of Basel II in the early 2000s. The reason for revision was that earlier rules did not fully capture operational and credit risks embedded in complex instruments. This works because financial innovation had outpaced static capital formulas. Basel II introduced three pillars: minimum capital requirements, supervisory review, and market discipline through disclosure. Banks could use internal models to estimate risk, subject to regulatory approval. While this approach aimed to align capital more closely with actual exposure, it also increased reliance on quantitative assumptions. According to later analyses, weaknesses in these models became evident during the global financial crisis. The tension between flexibility and simplicity remained unresolved as markets grew more intricate. The crisis of 2007 and 2008 revealed profound gaps in international oversight. Major institutions across the United States and Europe required emergency support as interbank markets froze. Governments intervened with liquidity facilities, guarantees, and recapitalizations to prevent systemic collapse. In its aftermath, regulators negotiated Basel III, which strengthened capital definitions and introduced liquidity coverage ratios. The mechanism of these reforms focused on resilience under stress scenarios. Higher quality capital and mandatory buffers sought to reduce the probability of taxpayer-funded rescues. Supervisory colleges were formed to coordinate oversight of cross-border banks. Transparency requirements increased, and stress testing became routine. The architecture of regulation continued to evolve as authorities confronted new risks emerging from shadow banking and digital finance. Global regulatory reform after the financial crisis moved beyond capital ratios and began to address liquidity risk in a systematic manner. Supervisors concluded that many institutions had appeared solvent yet failed because they could not secure short-term funding. The mechanism of liquidity coverage ratios required banks to hold high-quality liquid assets sufficient to survive a defined period of stress. This works because readily marketable securities can be sold or pledged to meet sudden withdrawals. Regulators also introduced net stable funding ratios to reduce dependence on volatile wholesale markets. These measures sought to realign funding structures with the maturity of assets on balance sheets. Implementation required detailed reporting templates and standardized definitions across jurisdictions. Banks invested heavily in compliance systems to monitor daily liquidity positions. The architecture of oversight became more data-intensive and continuous than in earlier decades. Supervisory stress testing emerged as another central pillar of post-crisis regulation. Authorities designed hypothetical scenarios involving recessions, asset price declines, and funding disruptions. The mechanism of stress testing evaluates whether capital buffers remain adequate under adverse conditions. This works because forward-looking analysis can reveal vulnerabilities not visible in static balance sheets. Large institutions were required to submit detailed projections of earnings and losses under these scenarios. Supervisors reviewed modeling assumptions and sometimes imposed additional capital requirements. Public disclosure of aggregate results aimed to reinforce market discipline. Over time, stress testing cycles became annual exercises embedded in supervisory calendars. The process reshaped internal risk management cultures within international banks. Regulation also expanded to address activities beyond traditional deposit-taking institutions. By 2010, policymakers recognized that credit intermediation had migrated into less regulated entities often described as shadow banking. At the time, money market funds, structured investment vehicles, and securities lenders played significant roles in short-term funding markets. The crisis revealed that these entities could transmit shocks rapidly when investors withdrew funds. Authorities responded with new reporting obligations and, in some cases, capital or liquidity requirements. By 2013, international bodies had issued recommendations to monitor leverage and maturity transformation outside the banking perimeter. The objective was not to eliminate non-bank finance but to reduce systemic spillovers. Cooperation among securities regulators and central banks intensified. Oversight increasingly focused on the financial system as a whole rather than on individual institutions alone. Cross-border resolution planning became a priority as governments reflected on the cost of emergency rescues. During the crisis, uncertainty about how to wind down complex multinational banks had amplified panic. The mechanism of resolution frameworks established legal tools to restructure or close failing institutions without disrupting critical functions. This works because predefined procedures reduce uncertainty and allocate losses according to established hierarchies. Authorities required large banks to prepare living wills describing their organizational structures and contingency plans. Host and home supervisors coordinated to clarify which entities would bear losses in different jurisdictions. Bail-in instruments were introduced to convert certain debts into equity during distress. These reforms aimed to limit the use of taxpayer funds while preserving financial stability. International dialogue remained essential because major banks operated across many legal systems. Technological change introduced new dimensions to regulatory oversight in the 21st century. Digital payment platforms and online lending services expanded rapidly across borders. The mechanism of regulatory technology sought to automate reporting and enhance supervisory analytics. This works because large volumes of transaction data can be processed in real time to detect anomalies. Authorities developed specialized units to monitor cyber risk and operational resilience. Banks were required to maintain robust information security frameworks and incident response plans. Cloud computing and third-party service providers created additional dependencies requiring oversight. Cross-border data flows raised questions about privacy and jurisdiction. Regulation adapted gradually as innovation continued to reshape financial intermediation. Capital standards continued to evolve through incremental revisions collectively known as Basel III reforms. By the late 2010s, supervisors had refined risk-weight calculations and introduced leverage ratios as a non-risk-based backstop. At the time, debates persisted over the balance between simplicity and risk sensitivity. The leverage ratio imposed a minimum capital level relative to total exposures regardless of asset classification. This mechanism limited the buildup of excessive leverage even if internal models underestimated risk. Countercyclical capital buffers were designed to increase requirements during periods of rapid credit growth. Authorities could release these buffers during downturns to support lending. Implementation timelines were extended to allow banks to adjust gradually. The cumulative effect was a thicker and more standardized capital framework across major financial centers. Emerging markets faced distinct challenges in applying global regulatory standards. Many banking systems were smaller and more concentrated than those in advanced economies. The mechanism of proportional regulation allowed supervisors to tailor requirements based on institutional complexity. This works because imposing identical standards on all banks could restrict credit in developing economies. International financial institutions provided technical assistance to strengthen supervisory capacity. Peer reviews assessed consistency in implementing agreed principles. Capital flows to emerging markets often fluctuated sharply in response to global interest rate changes. Regulators therefore combined macroprudential tools with traditional supervision to manage volatility. Coordination with foreign parent banks remained critical in jurisdictions hosting subsidiaries of multinational groups. The history of regulation and oversight reveals a gradual shift from reactive measures to structured global coordination. Early reforms followed crises and focused on repairing immediate weaknesses. Over time, policymakers sought to anticipate risks embedded in interconnected balance sheets. The mechanism of macroprudential policy expanded the lens beyond individual firms to system-wide vulnerabilities. This works because financial instability often arises from collective behavior rather than isolated misconduct. Data sharing agreements and supervisory colleges institutionalized cross-border communication. Periodic reviews assessed the effectiveness of standards and identified unintended consequences. The framework remained dynamic as markets evolved and new instruments emerged. International banking continued to operate within a regulatory environment shaped by experience, negotiation, and ongoing adaptation. In the years following the implementation of Basel III, regulatory attention shifted toward the broader concept of systemic resilience. Policymakers recognized that capital and liquidity buffers, while essential, could not eliminate the cyclical nature of finance. The mechanism of macroprudential oversight aimed to monitor credit growth, asset price inflation, and leverage across the entire system. This works because vulnerabilities often accumulate during periods of optimism when risk perceptions decline. Authorities developed indicators to track interconnected exposures among banks, insurers, and non-bank financial institutions. Countercyclical tools, including sector-specific capital requirements, were deployed in several jurisdictions. Supervisors increasingly relied on data aggregation to identify concentrations in real estate or corporate lending. International forums facilitated the exchange of methodologies and stress scenarios. Oversight became both more preventive and more coordinated across borders. Climate-related financial risk emerged as a new dimension of regulatory concern during the 2010s. Central banks and supervisory agencies examined how environmental transition and physical climate events could affect loan portfolios. The mechanism of climate stress testing assessed exposure to carbon-intensive industries and vulnerable geographic regions. This works because long-term environmental changes can translate into credit losses and market volatility. Supervisory guidance encouraged banks to incorporate environmental risk into governance and disclosure frameworks. International working groups developed common reporting standards to enhance comparability. Financial institutions began publishing scenario analyses aligned with global climate objectives. Regulation expanded beyond traditional financial metrics to encompass sustainability considerations. The scope of oversight gradually reflected broader economic transformations. By 2015, international bodies had intensified efforts to address misconduct and governance failures revealed during the crisis. At the time, investigations into benchmark manipulation and anti-money laundering deficiencies had eroded public trust. Authorities imposed substantial fines and strengthened compliance expectations. By 2017, many jurisdictions had introduced senior manager accountability regimes to clarify individual responsibility. According to supervisory reports, enhanced conduct standards aimed to improve risk culture within institutions. Regulators required independent board oversight and clearer internal reporting lines. Enforcement actions were publicized to reinforce deterrence. These measures underscored that stability depended not only on capital adequacy but also on ethical management. Oversight incorporated qualitative assessments alongside quantitative metrics. The mechanism of cross-border information sharing became increasingly formalized through memoranda of understanding and supervisory colleges. The reason such cooperation was necessary lay in the complexity of multinational banking groups. This works because fragmented oversight can allow risks to migrate between subsidiaries and branches. Home and host regulators coordinated examinations and exchanged findings on asset quality and liquidity positions. Joint inspections were conducted for systemically important institutions. Crisis simulation exercises tested communication channels under hypothetical stress events. Legal reforms in several countries facilitated the sharing of confidential supervisory data. International standards emphasized equivalence and mutual recognition to reduce duplication. Cooperation remained imperfect but more structured than in earlier eras. Financial technology introduced both opportunities and supervisory challenges in the evolving regulatory landscape. Digital banks operated without extensive branch networks, relying on online platforms to attract deposits across borders. The mechanism of licensing frameworks adapted to assess technological infrastructure and cybersecurity resilience. This works because operational failures in digital systems can trigger rapid loss of confidence. Regulators evaluated outsourcing arrangements with cloud service providers and payment processors. Cross-border data storage raised questions about jurisdiction and consumer protection. Supervisory authorities experimented with regulatory sandboxes to observe innovation under controlled conditions. International discussions addressed the oversight of crypto asset service providers and stablecoin arrangements. The regulatory perimeter continued to expand in response to technological change. Resolution planning matured further as authorities refined tools for managing failing institutions without systemic disruption. Living wills became more detailed, mapping legal entities, critical functions, and funding channels. The mechanism of total loss-absorbing capacity required large banks to issue instruments that could be converted to equity during distress. This works because predetermined loss allocation reduces uncertainty and protects depositors. Cross-border crisis management groups coordinated contingency strategies among relevant jurisdictions. Periodic resolvability assessments evaluated whether plans were credible and operational. Market participants monitored these disclosures to assess institutional strength. The objective remained to balance financial stability with market discipline. Resolution frameworks represented a practical extension of regulatory oversight into moments of failure. By the early 2020s, regulators confronted new tests as global economic conditions shifted. The pandemic disrupted supply chains and prompted extraordinary fiscal and monetary responses. At the time, central banks provided liquidity facilities to ensure smooth functioning of funding markets. Supervisors temporarily relaxed certain capital buffers to support lending. According to official communications, these measures were designed to preserve credit flows to households and businesses. As inflation pressures later intensified, monetary tightening exposed vulnerabilities in interest rate risk management. Several regional bank failures highlighted the importance of robust supervision even outside the largest institutions. Authorities reviewed deposit insurance limits and liquidity frameworks. The episode reaffirmed that oversight must evolve with changing macroeconomic environments. The history of regulation and oversight within international banking reveals a continual process of adaptation shaped by crisis and innovation. Each reform cycle has sought to address deficiencies revealed by previous disruptions. The mechanism of global standard setting has created a shared vocabulary of capital, liquidity, and governance. This works because consistent definitions reduce uncertainty and enhance comparability across jurisdictions. Yet diversity in legal systems and economic structures ensures that implementation remains uneven. International dialogue persists through established institutions and periodic negotiations. Supervisors balance prudence with the need to sustain financial intermediation that supports trade and investment. The architecture of oversight remains unfinished, adjusting incrementally as new forms of risk emerge within an interconnected global system. Modern international banking emerged from the institutional foundations laid in the aftermath of the Second World War. The previous era had been defined by fragmentation, competitive devaluations, and recurring financial instability. In response, policymakers sought to construct a framework that would reduce volatility and encourage cross-border investment. By 1944, representatives from 44 nations met at the Bretton Woods Conference to design a new monetary architecture. The agreement established a system of fixed exchange rates anchored to the United States dollar. The dollar itself was convertible into gold at a fixed price, creating a hybrid standard. This arrangement provided predictability for trade settlement and capital flows. It also elevated American financial institutions into a central position within the global system. International banking began to operate within a structured hierarchy rather than an informal network of correspondent relationships. Two key institutions formalized this new order: the International Monetary Fund and the World Bank. The mechanism behind their creation reflected lessons drawn from interwar collapse. The reason policymakers favored multilateral institutions was to prevent unilateral actions that could destabilize currencies. The International Monetary Fund provided short-term balance of payments support to member countries. This worked because pooled capital allowed temporary deficits to be financed without immediate devaluation. The World Bank focused on reconstruction and long-term development lending. According to historical records from the early post-war period, initial loans concentrated on rebuilding European infrastructure. Over time, its mandate expanded toward emerging economies in Asia, Africa, and Latin America. Together, these institutions formed a safety net that supported the growth of international banking activities. By the late 1950s, structural pressures began to strain the Bretton Woods framework. At the time, expanding global trade required a growing supply of dollars outside the United States. European banks accumulated dollar deposits that were not directly subject to American regulation. This development led to the emergence of the eurodollar market, centered primarily in London. By 1963, offshore dollar deposits had grown into a significant parallel system of liquidity creation. The mechanism of the eurodollar market allowed banks to lend dollars beyond domestic reserve constraints. This worked because deposits held outside U.S. jurisdiction did not face the same regulatory requirements. International banking activity accelerated as multinational corporations demanded flexible financing options. The result was a layered system in which offshore markets complemented formal monetary arrangements. In 1971, mounting imbalances forced a decisive shift in global monetary policy. President Richard Nixon announced the suspension of dollar convertibility into gold. By 1973, major currencies moved toward floating exchange rates. The fixed anchor that had defined post-war banking was removed. The mechanism of floating rates transferred adjustment pressures from central banks to currency markets. This worked because exchange values could fluctuate in response to supply and demand. Commercial banks expanded foreign exchange trading operations to manage new forms of risk. Derivatives markets developed to hedge currency exposure. The international banking system became more dynamic, but also more complex and interconnected. The late 20th century saw deregulation reshape financial institutions across advanced economies. In the United States, the gradual dismantling of restrictions culminated in the repeal of parts of the Glass-Steagall framework in 1999. In the United Kingdom, reforms known as the Big Bang in 1986 liberalized capital markets and encouraged foreign participation. By the 1990s, large banks operated as universal institutions combining commercial lending, investment banking, and asset management. The mechanism of consolidation increased efficiency through scale and diversification. This worked because broader revenue streams reduced dependence on any single line of business. According to studies published by international financial bodies, cross-border banking claims grew rapidly during this period. Capital could move across continents in seconds through electronic networks. The architecture of global finance began to resemble an integrated web rather than a collection of national systems. At the same time, regulatory coordination became more formalized. The Bank for International Settlements in Basel provided a forum for supervisory cooperation. By 1988, the Basel I Accord established minimum capital requirements for internationally active banks. At the time, concerns centered on maintaining stability amid rapid balance sheet expansion. The mechanism of capital ratios required banks to hold equity proportional to risk-weighted assets. This worked because higher capital buffers absorbed potential losses. Subsequent accords, including Basel II and Basel III, refine these standards in response to evolving risks. According to central bank reports, implementation varied across jurisdictions but aimed at convergence. International banking thus operated under increasingly harmonized oversight, even as innovation accelerated. The early 21st century revealed both the strengths and vulnerabilities of this integrated system. In 2008, the collapse of major financial institutions triggered a global crisis that spread through interbank markets. The failure of Lehman Brothers disrupted short-term funding channels worldwide. Liquidity froze as counterparties questioned each other's solvency. Central banks responded with coordinated interventions, including swap lines and quantitative easing programs. The mechanism of emergency liquidity provision stabilized funding markets by restoring confidence. This worked because credible backstops reduced the incentive to withdraw deposits or halt lending. Modern international banking emerged from the crisis more regulated and more scrutinized. Yet its essential character remained defined by cross-border flows, digital infrastructure, and the continuous balancing of risk and trust within a global framework that continues to evolve. Digital infrastructure gradually became the backbone of modern international banking. Transactions that once required physical documentation shifted to secure electronic messaging systems. The Society for Worldwide Interbank Financial Telecommunication, known as SWIFT, standardized cross-border communication beginning in the 1970s. This network did not move money itself but transmitted authenticated instructions between institutions. The mechanism reduced settlement delays and operational errors. This worked because standardized message formats minimized ambiguity across jurisdictions. As global trade volumes expanded, the reliability of digital messaging became essential. Large value payment systems operated continuously across time zones. Banks invested heavily in cybersecurity to protect sensitive data flows. The architecture of modern banking, therefore, depended not only on capital strength but also on technological resilience. Infrastructure spending became a strategic priority for internationally active institutions. Over time, technological capability evolved into a competitive differentiator among global banks. Parallel to these developments, capital markets deepened and diversified across continents. International bond issuance expanded beyond sovereign borrowers to include corporations and financial institutions. The mechanism of syndicated lending allowed risk to be distributed among multiple banks. This worked because no single balance sheet carried the full exposure of large cross-border projects. According to data from multilateral financial institutions, emerging markets increasingly accessed global funding pools during the 1990s and early 2000s. Cross-listing of equities connected domestic firms to foreign investors. Currency swaps and interest rate derivatives facilitated risk management on a global scale. Banks developed specialized desks dedicated to structured finance and cross-currency products. Competition intensified as institutions sought advisory mandates for mergers and acquisitions spanning jurisdictions. Financial integration accelerated the circulation of savings toward investment opportunities worldwide. The scale of international banking activity expanded in both volume and complexity. By the early 2000s, regulatory authorities recognized that innovation required updated oversight frameworks. At the time, off-balance sheet vehicles and securitized products had grown rapidly. The mechanism of securitization transformed illiquid loans into tradable securities. This worked because pooled cash flows could be structured into tranches with varying risk profiles. According to central bank assessments published before the global financial crisis, dispersion of risk was believed to enhance stability. In practice, opacity sometimes obscured underlying asset quality. Cross-border investors purchased complex instruments without full visibility into credit exposures. Rating agencies played a significant role in assigning perceived safety levels. The international banking system became tightly interconnected through these instruments. When stress appeared in one segment, transmission channels carried it quickly across markets. The experience reinforced the importance of transparency and coordinated supervision. Following the crisis of 2008, reforms reshaped capital, liquidity, and resolution standards. The Financial Stability Board coordinated international efforts to strengthen oversight. The mechanism of higher capital requirements under Basel III increased loss-absorbing capacity. This worked because thicker equity buffers reduced leverage ratios across major institutions. Liquidity coverage ratios required banks to hold high-quality liquid assets. Stress testing frameworks evaluated resilience under adverse macroeconomic scenarios. According to official reports, systemically important banks faced additional supervisory scrutiny. Resolution planning introduced the concept of living wills for large cross-border entities. The objective was to prevent disorderly collapse with taxpayer-funded rescues. Modern international banking entered a period defined by compliance intensity and structural reform. Balance sheets adjusted gradually to the new regulatory environment. At the same time, financial globalization continued to evolve geographically. Asian financial centers expanded their influence in trade finance and capital markets. The rise of China as a major economic power altered cross-border payment patterns. By the 2010s, the renminbi gained recognition within the reserve currency framework of the International Monetary Fund. Offshore clearing hubs facilitated settlement in multiple currencies. The mechanism of currency internationalization relied on trade invoicing and swap agreements. This worked because broader usage increased liquidity and confidence. Regional development banks supported infrastructure connectivity across emerging economies. International banking relationships reflected shifting trade corridors and supply chains. Financial institutions diversified their presence to capture growth in Asia and other dynamic regions. The global map of banking influence became more multipolar than in earlier decades. Technological change accelerated further with the emergence of financial technology firms. Digital payment platforms introduced new competitive pressures for traditional banks. The mechanism of application programming interfaces enabled data sharing between institutions and third-party providers. This worked because interoperability fostered innovation while preserving core banking functions. Blockchain-based settlement experiments explored alternatives to correspondent banking chains. According to industry studies, distributed ledger technology promised efficiency gains in specific use cases. Central banks began researching digital currencies to complement existing payment systems. Cross-border remittances became a focal point for cost reduction initiatives. Established banks responded by investing in internal innovation labs and strategic partnerships. Modern international banking increasingly blended legacy infrastructure with experimental digital solutions. Adaptation became necessary for maintaining relevance in a changing environment. Risk management frameworks also matured in response to heightened uncertainty. Geopolitical tensions introduced new dimensions to compliance and sanctions screening. The mechanism of Know Your Customer procedures expanded to address money laundering and terrorist financing concerns. This worked because standardized verification reduced exposure to illicit flows. According to reports from supervisory agencies, enforcement actions carried significant financial penalties. Banks enhanced internal monitoring systems using advanced analytics. Climate-related financial risks entered strategic planning discussions. Scenario analysis evaluated potential impacts of environmental transition on asset values. International banking institutions integrated sustainability considerations into lending policies. The scope of oversight extended beyond traditional credit and market risk categories. Governance structures evolved to incorporate broader stakeholder expectations. Despite these transformations, the fundamental function of international banking remained consistent. Institutions intermediated savings and investment across borders. The mechanism of trust continued to underpin deposit-taking and lending relationships. This worked because confidence in counterparties enabled the extension of credit. Digital speed did not eliminate the need for prudent judgment. Regulatory harmonization coexisted with national interests and domestic priorities. Capital flowed in response to opportunity but retreated when uncertainty intensified. International banking thus operated within a delicate balance of integration and sovereignty. Its modern form reflected decades of institutional layering and adaptation. The system stood as a complex network sustained by technology, regulation, and enduring economic interdependence. In the years following the global financial crisis, central banks assumed a more visible role in shaping international banking conditions. Monetary policy tools expanded beyond traditional interest rate adjustments. Large-scale asset purchase programs influenced liquidity across sovereign bond markets. The mechanism of quantitative easing injected reserves into banking systems through securities purchases. This worked because central bank balance sheet expansion lowered long-term borrowing costs. Swap lines between major central banks provided foreign currency funding during periods of stress. According to official statements released during crisis episodes, these facilities were designed to stabilize global dollar liquidity. International banks relied on such arrangements to maintain funding continuity. The relationship between monetary authorities and commercial institutions therefore deepened. Central banking coordination became an integral feature of modern financial stability management. Policy communication itself evolved into a stabilizing instrument within international markets. The structure of global banking groups also continued to adapt under post-crisis supervision. Many large institutions reorganized into holding company frameworks with ring-fenced subsidiaries. The mechanism of structural separation sought to isolate retail deposits from higher-risk investment activities. This worked because legal partitioning reduced contagion between business lines. Resolution regimes emphasized bail-in provisions rather than taxpayer-funded rescues. According to regulatory guidance, loss-absorbing instruments were designed to convert into equity during distress. Cross-border cooperation agreements clarified supervisory responsibilities among host and home authorities. International colleges of supervisors met regularly to exchange information. Capital allocation decisions increasingly reflected stress testing outcomes. Governance standards emphasized board-level accountability for risk culture. Modern international banking thus operated within a dense network of oversight relationships. Institutional resilience became a measurable objective rather than an implicit expectation. Technological transformation continued to reshape competitive dynamics within the industry. Cloud computing allowed banks to scale operations without equivalent physical infrastructure expansion. The mechanism of shared digital platforms reduced marginal costs for transaction processing. This worked because centralized data environments improved efficiency and analytics capacity. Artificial intelligence tools enhanced fraud detection and credit assessment models. According to industry research, machine learning systems processed patterns beyond human capability. At the same time, reliance on third-party service providers introduced concentration risk considerations. Regulators examined operational resilience frameworks in response to digital dependency. Cybersecurity strategies evolved into board-level priorities. International banking increasingly resembled a technology-driven service network layered over traditional balance sheets. Innovation cycles shortened as institutions responded to customer expectations for seamless cross-border services. Digital currencies introduced a new dimension to the evolution of international finance. Private sector initiatives explored stable value tokens backed by reserve assets. Central banks examined sovereign digital currency models for domestic and cross-border settlement. The mechanism of distributed ledger systems allowed near real-time transaction verification. This worked because consensus protocols reduced reconciliation delays between counterparties. According to publications from the Bank for International Settlements, pilot projects tested interoperability across jurisdictions. Cross-border payments remained a focus due to historically high costs and delays. Commercial banks assessed how digital currencies might complement or compete with existing correspondent structures. Legal frameworks adapted gradually to address custody and settlement finality questions. The experimentation phase reflected cautious exploration rather than wholesale replacement. International banking institutions monitored these developments while preserving established payment rails. Geopolitical fragmentation introduced additional complexity into global financial integration. Sanctions regimes expanded in response to regional conflicts and policy disputes. The mechanism of financial sanctions leveraged payment systems and correspondent networks to exert pressure. This worked because access to clearing currencies functioned as a strategic asset. According to government announcements during recent crises, targeted restrictions aimed to isolate specific institutions from global markets. Banks enhanced compliance systems to screen transactions against evolving lists. Cross-border capital flows adjusted as firms reassessed exposure to political risk. Regional payment arrangements gained attention as alternatives to dominant currencies. International banking operated at the intersection of economic logic and national policy objectives. The balance between openness and security became a recurring theme in strategic planning discussions. Sustainability considerations further influenced capital allocation patterns. Environmental, social, and governance metrics entered credit assessment processes. The mechanism of green bond issuance directed funds toward climate-related projects. This worked because investor demand aligned with long-term transition goals. According to reports from multilateral development institutions, sustainable finance volumes expanded rapidly during the past decade. Banks developed internal taxonomies to classify environmentally aligned activities. Disclosure standards sought to improve comparability across jurisdictions. Risk models incorporated potential carbon transition scenarios. International lending decisions increasingly reflected regulatory guidance on climate exposure. The integration of sustainability criteria represented an additional layer within global banking analysis. Financial intermediation thus extended beyond profit optimization toward broader systemic objectives. Throughout these transformations, emerging market economies continued to navigate integration challenges. Capital inflows provided investment resources but also introduced volatility. The mechanism of macroprudential policy tools attempted to moderate excessive credit growth. This worked because countercyclical buffers could dampen speculative expansion. According to assessments by international financial organizations, balanced capital account management remained essential for stability. Currency mismatches posed ongoing risks for borrowers with foreign-denominated debt. Domestic banking supervision strengthened in many jurisdictions. Regional safety nets complemented global institutions in providing liquidity support. International banks adjusted exposure based on sovereign risk perceptions. The experience highlighted enduring asymmetries within the global system. Integration offered opportunity while demanding institutional robustness. Modern international banking, therefore, stands as the cumulative result of layered institutional change. It operates through digital networks, regulatory frameworks, and coordinated central bank action. The mechanism of trust continues to bind counterparties across borders despite rapid technological shifts. This works because confidence in legal systems and settlement processes underpins financial exchange. The system absorbs shocks through capital buffers, liquidity facilities, and supervisory collaboration. Yet it remains sensitive to geopolitical strain and economic imbalance. Capital mobility connects distant markets with immediate consequences. Institutions adapt continuously to regulatory reform, innovation, and shifting power centers. The architecture is neither static nor complete. It evolves incrementally as new pressures emerge and established structures adjust, carrying forward the long historical arc of international banking into an uncertain but interconnected future.